We are live, Mr. Chair.
Thank you very much. I'd like to call the meeting to order this afternoon and acknowledge that we are in Treaty 1 territory, the home and traditional lands of the Anishinaabe, Ojibwe, Inuit, Cree, and Dakota peoples, and in the national homeland of the Red River Métis. Our drinking water comes from Shoal Lake 40 First Nation in Treaty 3 territory. My name is Brent McIntyre, and I'll be chairing the meeting this afternoon. And zooming in is Gail Anderson and Bob Belinkie. Our assessor for today's hearing is Svetlana Shalbo, and our administrative personnel is Jaswinder Kumar. We will be hearing applications for revision of the assessment roll in accordance with the Municipal Assessment Act. The matters for which revision is requested have been described in each application, and we will limit discussion to those matters. The statements that are made at this hearing are sworn testimony, and anyone speaking to the matters must be sworn in. Be advised that comparisons of assessments of properties are not considered evidence of market value by the Board of Revision. The Board of Revision is appointed annually by Council and is independent of it and the City Administration. It makes its decisions on the basis of the evidence provided at this hearing and issues a written order that will be mailed to all parties as soon as possible. Please note that the Board's decisions with respect to an application may be appealed to the Manitoba Municipal Board if the matter pertains to assessed value or classification, or to the Court of King's Bench if the matter pertains to the application of exemptions from taxation. Should you wish to appeal, information on how to do so will be included with the Board's order. With respect to the hearing process, I will confirm the points of appeal with your property to be addressed, with each applicant following the swearing in. We will then have the assessor's testimony followed by questions that the applicant may have, and then the applicant's testimony followed by questions. Each side will have an opportunity to summarize if they wish. Once all of the evidence about an application has been brought forward, the applicant may leave. The process will repeat for each item on the docket today. The session will close after all the applications have been heard, and the Board will deliberate in private and make its decisions. You will receive the Board's decision by registered mail as soon as possible. As information, all public hearings are live streamed, recorded, and will be part of the public record. We will be hearing items 1 through 8 on our docket today. Mr. Kumar, please affirm the assessor's and the applicant's testimony. Thank you very much.
Yes, thank you. Madam Assessor, please state your full name.
Svetlana Shalbo.
Thank you. Do you affirm that the evidence you are about to give at this hearing is the truth, the whole truth, and nothing but the truth?
Yes, I do.
Thank you. Mr. Neufeld, please state your full name.
Rocky Neufeld.
Do you affirm that the evidence you are about to give at this hearing is the truth, the whole truth, and nothing but the truth?
Yes, I do.
Thank you. Mr. Mercury, please state your full name.
James Mercury.
Thank you. Do you affirm that the evidence you are about to give at this hearing is the truth, the whole truth, and nothing but the truth?
I do.
Thank you.
Thank you very much. The first item on the docket is 200 Portage Avenue. And are there any preliminary issues with this property, either party?
There's some preliminary issues with the entire docket. I just want to clarify. This was originally scheduled October 19th. One property was heard, then it was adjourned, then rescheduled for January 11th, which was a conflict. But the new letter came out for January 11th hearing with a new evidence exchange date. And then on January 11th, it was changed to today's hearing. So I think the issue we have is we have briefs that dated back from October 19th. Then we have briefs I know I submitted for the January 11th. The clerk just told me a few minutes ago that there might be other briefs put in by the assessor. I have nothing, and from what our conversation, I don't want to get in details of it, there appears to be a change on one property in particular. I'm wondering if we don't have those ones for the January 11th, or they could be forwarded, and are those the ones being relied on?
Those documents being forwarded to you, Mr. Neufeld, on January 18th, I believe.
I'm looking at January 18th, and I got nothing showing on my mailbox. January 18. from board. I've got one for 180 King that was sent to me.
Okay. Yeah. The other email is on January 17th at
Okay.
1:41 p.m.
January 7th,
17th, yeah.
okay, I've got a January 30th. Or sorry, I have a January 17th. So some back and forth. I've got nothing into me. I've got receipt of my evidence. And I don't think that this is gonna be a major issue, but if there was a change or something, I'm just wondering if you couldn't forward the assessor's briefs that you sent. Maybe they went to somebody else in my organization. I don't have anyone here I can check with.
I can forward the same again if you want.
Oh, yeah, that would be helpful.
Yeah, no problem. Mhm.
And yeah, and start with if you could 298 Fort.
Well, that's
Mr.
fourth on the docket.
Pardon me?
That's number 4 on the docket.
No, I realize there's another reason for it, and I'm going to ask in a second. I don't want to take charge of your hearing. Don't worry. I'm
not worried.
Mr. Mercury's here for a specific reason.
So is he here for 298 Fourth?
Yes.
And that's the only property?
Yes. But again, I found out I have different evidence than you may have.
I send you the email again, so you can.
Okay.
You got
Jazz,
it?
you sent it?
I got the first batch here. I'm just oh no, no, something else. Never mind. I just got 2 briefs on from a different day. I was getting all excited there. No, still waiting.
There's seven files in attachment.
And Jazz, is that the same as the docket we're looking at today?
Oh, yes, Mr. Chair. Can we go for a break just to figure this out, Mr. Chair?
Certainly, we can take a 5-minute recess
Thank you.
or a 10 if you need it.
We are live, Mr. Chair.
Thank you very much. We'll reconvene the hearing this afternoon. The first property on the docket is 200 Portage Avenue. And are there any preliminary issues with this property, either party?
No.
Rocky?
No.
Okay, Svetlana, you can start your presentation.
File number 22-3067. Roll number 12093009500. It's 200 Portage Avenue. We are valuing the property as it stands of January 1st, 2023, based on the economic condition of April 1st, 2021. This appeal is with respect to the amount of the assessed value only. Based on the evidence in this report, in this assessor opinion, that the market value of subject property as of April 1st, 2021 is $16,315,000, and then the 2023 assessed value should be confirmed. The subject property is office building, original built in 1979, suited on land area of 21,280 square feet, and leasable area 83,421 square feet. The subject property was sold in 2017 for $16 million. It's 4 years before reference date. The subject property has existing leases. I just posted income expense mailers right here. We have lease for around 2,000 square feet at $22.50. A lease of 17,789 square feet at $19. And we can see on the bottom annual rent, commercial rent average $21.84. It's average for 25,896 square feet. Subject property after sale in 2017 has a renovation. We can see size 2017, 2019 include. Renovation was over $3 million. On page number 3, subject property, air photo and street view. On page 4, it's OB rent comparables, market study analysis, and you can see 200 Portage Avenue. It's our second property. We can look on average stabilized rent, $19 average weight. We can see media and $19. Vacancy average 46.4%. So we keep going. If you go in market study analysis on page number 6, we can see average rent $14.85. Outside sources on Johnson report on page number 7. We can see Cushman and Wakefield showed average rent in 2020 was $15.94. Johnson report average rent showed $15.40. On page number 8, it's a market income for subject property. We did apply $16.82 for 83,421 square feet. We apply vacancy loss 11%, expenses 3%, shortfall $12 per square foot, and overall capitalization rate 6.75%. That gives us estimate value of subject property $16,315,000. On page 12, started income expense mailer provided for us 2020 years, whole years. All permits about renovation started on page 21, 22, 23, 24. So based on evidence and this report, the subject property market value of April 1st, 2021 is 16,315,000, and that the 2023 assessed value should be confirmed. Thank you. Any questions?
Thank you. Rocky?
Yeah, just, 1 sec. I'm just, finding my place here. Yes, firstly, the valuation that you have on page 8 and 9, was this all done by the model?
Yes, it's model driven.
Okay. And no overrides there?
No.
Okay, on page, and it's listed in quite a few places. Oh, wait, sorry, I'm gonna go back to page 2. Who was the vendor in this sale?
So it's a sale on open market for 16 million in 2017.
Do you know who sold it?
No, I have to look in my records. It's take time to open. But sale was happened 4 years before reference date. And we assess just over sale price. It's fair. Wow, it's like take forever to open my file. Sorry, be with me, it's still opening. What's wrong? Portrait. Okay, I'm on site. Sale was happened between Scotia Realty Limited and 200 Portrait Inc.
So Bank of Nova Scotia sold the building, and do you have the information from the mailer of 2000 and
Industrial instrument number 4837542. It's
Yeah,
a sale on open market for 16 million.
okay, Bank of Nova Scotia sold. Do you have their mailer from 2018?
It's not relevant for 2021
Do
assessment.
you have their mailer from 2018?
And my end of my brief, I posted mailer 2020. And we can see average commercial rent $21.84. And we assess at $16.82 cents average. It's fair.
My question is, were you aware that as part of the sale, Bank of Nova Scotia agreed to lease the entire building back?
And that's a yes or no question, Svetlana.
Yeah, no answer. It was sale on open market. What I know. I cannot open it.
So the answer is no.
I don't know.
Okay. Let's move on.
Okay, so on page 2, we're now listing only, it says 25,000 feet leased and 58,000 vacant. Was there some concern about the vacancy when the assessment was created?
That's why our vacancy 11% for this type of building.
Well, they're about 65-70%. Does that not indicate a problem?
It's indicate that I don't see any problem. You can see after sale in 2017, over was added to construction and alteration 3 million. Nothing wrong with the property.
As of April 1st, 2021, what are you showing as a vacancy in the building?
11%.
What are you showing as the actual vacancy in the building?
I don't show it because it's average. And usually vacancy 11% for 10 years. It's reasonable.
On your page 14, which is appears to be as of December 31st, 2020, do you not agree that you're showing, I'll give you the number.
On page 14, it's income expense mailer posted by me.
I'm asking about the actuals. Not asking about your model. Does not this indicate it's 69% vacancy? Your evidence, page 14.
Yes, it's reported to us. It showed that vacancy 58%, 58,000 and occupied 26,000.
Does the building have its own parking?
Let's look on photo. On page number 3. No.
These this
1 second.
table on page 5, 6, and 7. Well, actually, sorry, I just wanted to ask about page 4 and 5. You list 6 buildings here, correct?
Correct.
One of which is the subject.
Mm-hmm.
Now, on your subject listing, you have, again, 69.4% vacant for 2 consecutive years, correct?
Yes, it's of the market study from 2015 to 2020.
And when stabilized, you show 46.4%.
It's
now, if you've calculated 46.4% is stabilized, do you still think 11% is adequate?
yes, if you look on years 2015, reported to us was vacancy 8.3%, 2016 10.3%. Yes, in 2019, big tenants left that now 69.4%. But if it's only showed 6 years, but for 10 years 11%, it's reasonable.
For the 2 years of 2017 and 18, though,
It was 0%.
Yes, and those were the years when Bank of Nova Scotia agreed to rent for 2 years in order to sell their building, correct?
I no answer.
I'm sorry,
I don't know.
don't know, thank you. These particular buildings that you chose, are these the same type as the subject?
Yes, it says similar with subject property of B, market study analysis, 330 Portridge, 155 Carlton, 333 Main Street, and 191 Pioneer Avenue. It's information reported to us, analyzed 6 years ago.
Are all of these buildings in the same class as the subject?
All this building, same class and located in downtown.
And is that confirmation of the class? You've got some information later in your report indicating, I think, excerpts from the Johnson report.
Yes, on page number 7, it's analysis of global
Hey.
market.
No, page 18 and 19, 20. Are all of these properties in the same class?
18, 19. It's Johnson report.
That's what those pages are. So I'm
Yes,
asking
correct.
you if the 5 comparables you've chosen, one of which is the subject, so let's look at the other 4.
Mm-hmm.
Do you agree that 200 Portage is listed as Class B?
And listed like Class B, 330 Portridge, 155 Carlton, 330
Okay, well,
Main Street,
sorry,
and
you're
191 Pioneer Avenue. It's
you're
Class
getting ahead
B.
you're getting ahead of me. 330 Portage, is that listed as Class B?
In our system, yes.
Okay, and the vacancies in that building ranged from 12.2 to 26%, correct?
Yes, correct.
155 Carlton, is that in Class B?
Correct. And we can see vacancy average 3.2%.
Okay. 333 Main, what class is that in?
It's still Class B. And we can see vacancy average for 6 years, 5.3%.
And is not this entire building leased by Manitoba Hydro?
It's not relevant. We look for vacancy.
I'm sorry, I don't ask for your opinions on relevance. Just a yes or no. Is it not leased all by MTS?
You said
I
Manitoba
don't
Hydro.
know.
Hold it here.
Oh, sorry, I said that wrong. I
You
meant
said
MTS.
Manitoba Hydro.
353
Crown
Main Street.
Corporation.
Let's look on Johnson
Svetlana.
report. Yeah.
I'm asking him a question. He said Manitoba Hydro, and apparently that's not correct. So let him correct his statement.
Oh, thank you.
Are not 333 Main and 191 Pioneer rented by MTS? Fully.
If you open page 18 of my brief and look on Johnson report about existing leases, it's a free Main occupied by Main Pioneer, Winnipeg Inc. The net lease
That's owned by Maine Power Pioneer Winnipeg Inc. Is not the major full tenant MTS. And the same question goes for 191 Pioneer.
Pioneer. Yeah, it's same Pioneer Inc. owner. Its report in June 2020 showed 0 vacancy, but owner occupy something like this. 0 vacancy. It's vacancy report. Sorry, it's vacancy report. We look for vacancy with rent. Office vacancy. Only office vacancy. It's and Johnson report showed only office vacancy report, and we can see 191 Pioneer 0 vacancy, 333 Main Street they have vacancy percentage. I don't see percentage from around 10%, I guess. 1%, not 10, 1%, because 168,000 and vacancy only 6,000. But let's look on specific of subject property because it's site specific and they rent overall $21. It's reasonable. We apply less than $17 per square foot.
Are you aware that when 333 Main and 191 Pioneer were sold, they were sold by MTS to a private venture with a lease back, and that any leases that are now available in those are subleases from MTS?
That's why when you look on my page number 5, we have information only for 2016 about leases, rest it's owner occupied. We don't have any information about existing leases.
If you look on page, and I don't think you put this in your report. Let me just look at it.
Well, if she doesn't have it on her report.
No, I
why
know,
is it?
I'm not gonna ask it. I just wanted to see how far it goes here. The last page list is 59, and it's on page 60. That's fine, I have asked the question. So essentially what I'm seeing here, do you not see that that you really only brought in 2 buildings, being 333 Portage and 155 Carlton? The rest would not be considered relevant? Or do you agree with disagree with that?
Correct.
Which one's correct?
Because we don't have information for up to after 2016 for 333 Main Street in 191 Pioneer Avenue, but we still have 330 Portage and 155 Carlton, plus subject property 200 Portage Avenue. It's site specific, and you can see that what reported vacancy, for example, 155, 3.2%. For 330 Portage, 13.5%. We did 11% average for subject property. It's fair.
On these 5 that you brought forward, did you calculate the average by any chance?
No.
Vacancy? Including the subject, the other non-owner occupied ones, wouldn't you see that your average vacancy is even weighted the way you have is 21%?
I don't see a 21% vacancy.
I'm just looking at your weighted average and average.
About vacancy.
13.5.
Right now, subject property has high vacancy, but because major tenants left. But if you look on 330 Portage and 155 Carlton, vacancy between 3.2% to 13.5%. 11% applied to the subject property. It's fair. And look, before major business left, tenants, we have in 2015 8.3%, 2016 10.3%. It's reported to us, and 0 in 2017, 0 in 2018.
On your page where you listed the Johnson report, I believe that was page 14 or so. Sorry, no, that was page 18, 19, 20. How many Class B buildings are there in downtown Winnipeg?
Johnson report, let's look on Portage 18.
At the bottom, page 20, added up, 20, correct?
They show 29 total records.
I'm looking at 30 on your printout.
Class B on page 18.
Page 18, I'm looking at Class B. Oh, was that a different year? Class B on page 20? Oh, I see. Sorry, my error here. Okay. So
And you can see very good on page
29.
18 on bottom, you can see in 2020 in June, it was over 4,000,000 square feet.
Okay.
Vacancy was 11.1%. 14.15%. In 2019, for 4 million square feet, was vacancy 11.81%. We did apply for 2021 11%. It's fair. It's supported by Johnson report also.
Okay, so back to my question, and I misread this, but I'm okay. I'll look at page 18. There are 29 Class B buildings according to Johnson. What was wrong with the other 24 to include them in the vacancy calculation?
It's you can see percentage vacancy on bottom of this page, of page 19. And 14.15 on page 18 of bottom of this table.
Right.
So 11% what we apply for subject property.
And you know what? I think we've heard enough about the vacancy of this building and the comparables on her report.
Thank you.
Well, you know, it is a very important issue, and we'll get it out of the way now. I just had, I believe, 2 more questions on that. And looking at page 59, did you note that 60 Osborne and 100 Osborne, as well as 191 Pioneer, they're all bunched together, are showing 0% vacancies, and they are all occupied by single tenants, 2 of which are the owners? Would not the actual investment vacancy be much higher than the 14% you're showing
Possible.
in the Johnson? Okay. And
One moment, it's 4,000 square footage total rentable. Yeah. But it's still not around 11% what we did apply for subject property. It's market supported.
on your outside sources page, page 7, does not the Johnson report indicate a growing vacancy rate over time?
You can see Cushman and Wackfell showed average stabilized from 2018-20 10.2%. We apply 11. If you look on Johnson report, vacancy showed 7%. We apply only 11. It's fair.
Are you looking at these rates on the Johnson report? And I'm looking at the line called vacancy average, which is starts at 9.4 and increases to 15.7. Did this come from all properties, including owner-occupied ones, or does this
Correct.
come from the investment properties, which he has on page 54?
It's for all properties from Johnson report. I make mistake for Johnson and report. Average vacancy average 13%. For Cushman and Wakefield average 10.2%. So, but it's we apply only 11.
Johnson. Do you not know that there's a category called investment properties that allow you to exclude the owner-occupied rates?
No answer.
The income showing on your page 8, did you compare that to the statement, which is on your page 16?
On page 16, you can see that existing rent showed average $21.84. We apply only $16.82.
Okay, I'm talking about the potential rent. You have 1,403,000 on your model, and their actual rent, which is on your page 15, was 720,000, so half.
Because it's major tenant left, but outside sources showed between 5 to 13. 11, it's fair.
Okay, so but your potential rent is twice as high as actual. Is that the numbers correct?
Because I looking on existing leases and average $21, we apply only $16. It's fair.
And when you were talking about the leases, what did you do to treat the tenant improvement allowances?
Tenants improvement allowances not part of an income estimation. Income.
So may I paraphrase what you're saying is that you included the rent which had tenant improvement repayments in them?
I showed two existing leases in the subject property, but we apply $16.82 per square foot. It's model driven and support by market evidence.
What sort of accounting format were you using to determine the support for your statement?
To example, 330 Portrait Avenue, they showed average rent $15.66 and rent in 2020 $16.65. Why model
I think we're
less
talking
than $17 per square foot? If you're looking on 155 Carlton Avenue, average rent $14.
I think we may be talking about different things. Back up to page 2, you are showing a lease for G3 Canada that says a rent is $19, and then below you show $3 million in interior alterations.
It's extent subject property leases on page number 2. It's a copy for income expense mailer reported for us from page. It's posted full report posted on page 12 and further.
What sort of accounting method was used in that respect? Do you understand? I mean, I'm
Rocky, you know what? She said that was model driven.
yeah, okay. Just in general then about the model, does the model use, what sort of accounting system do you know of that the model uses, or do you know what it uses?
Model used all market evidence reported to us. Specific for 2020 years.
Does it follow IFRS standards?
And yes, for sure.
Then where is the adjustment for it? Do you know what that is?
Model analyzed existing rent reported to us. Income expense mailer reported to us.
Okay, so but the income and expense mailer, was there a breakdown to comply with IFRS?
No answer. All our study exists on reported income from properties. That's why we have penalty from Municipal Assessment Act.
On your
if
page,
we not have information provided for us, our model generate numbers from real existing numbers reported to us.
on your page 8, you allow 3% for expenses. Did you note that on the statement you provided that the non-recoverable expenses were considerably higher?
Statement provided to us is just for view. Model showed that expenses 3%, not more, but shortfall $12 per square foot.
Well, sorry, the expenses were 1.5 million, and that's on your page 16, and the recoveries were 328,000 on your page 15. So the shortfall is about $1.1 million of non-recoverable expenses. That's not an insignificant.
Let's look on specific comparables on page number 4. 330 Portrait Avenue, shortfall average $12.29. Carlton, 155 Carlton, shortfall average $11.01. That's why model it support to model $12 per square foot. If we look on not recoverable expenses, Average for 330 Portridge 11%, for 155 Portridge only 0.2%. Model driven 3%. It's fair. It's between.
Well, you say it's fair, but I see your page 8 allows a total of $147,000 in non-recoverables.
I'm looking for market evidence, not site specific.
Okay, do you have the statements from the other properties that you quoted today? You know,
If you look on page number 4,
are there non-recoverables
let's
listed?
look on page number 4 and look for 330 Portridge. Not recoverable expenses, it's last line of 330 Portridge. In 2015 was not recoverable 1.5%. In 2016, 4.5%. 2018 was 18.4%. 2018 was 10%. 2019, 12.6%. 2020, 10.4%. Average for 2020, 11%.
Okay, so you talked
It's
about
real numbers reported to us.
you talked
It's
about
real market evidence.
You talked about 330 Portage. So by your own evidence, you're showing that the average is 11% per year non-recoverables on that particular building, correct?
Because it's not just depend from one property. If you look in another property, 155 Carlton Avenue, it's a line of page number 5, not recoverable in 2015, 2.1. In 2016, 11.5%, 2017, 1.6%, 2018, 0.3%, 2019, 0%, 2020, 0.2%. So average for 2018, 2020, 0.2%. We apply 3%, it's fair.
I'm having some problems with the next one you mentioned. So you did sidestep my question though. 11% for 330 Portage is your average, correct?
Correct. But it's of another comparables. It's between 0.2% to 11%.
I'm glad okay, but I'm going to ask those questions. If you want to keep going ahead, that's fine. We're going to be here all day, and I'm not taking blame for that. 200 Portage.
Well, you know what? Both parties, we're not going to be here all day.
Yes. Okay. Well,
Let's move on.
200 Portage Avenue. We've just indicated $1 million in non-recoverables for the year of 2020. You've got it listed at 0% non-recoverables. That is an error, isn't it?
It was not reported to us. That's why it's 0.
You've reported in your statement, haven't you? Pages 15, 16, and 16. It's there, isn't it? $1 million.
It's unusual situation when major tenant left. It's not market evidence.
How did you do the next property? 155 Carlton. How did the average get to 0.2% when it appears to me when I do the math, it's 2.6%?
If you look on top of page number 4, stabilize it, 2018, 2020. It's 0.2%.
So you didn't use all 6 years there here for your average?
I showed all 6 years, but using only 2 years.
All right. Sorry, that's clarify that for me. And on the cap rate, you don't have any cap rate sales here. Are you relying on the model then entirely?
Yes, if you open page number 10 and we're looking on paragraph number 2, how for the 2003 general assessment, capitalization rate were derived from model generated estimates of net operating income in sale prices that were time adjusted to April 1st, 2021. The assessed value produced by the application of this model generated capitalization rate were compared to sale price and assessment to sale price ratio were calculated. The resulting ratio statistic for the assessment taxation department income producing models satisfy the standards specified and set forth in the Standard of Racial Studies published by the International Association of Assessing Officers.
And quite frankly, Svetlana, the board members have seen this chart numerous times. You don't need to read it out.
Thank you.
Thank you.
How many investment sales in office were there in the 2 years preceding the April 1st, 2021? Do you know?
The model analyzed all existing sales across the city.
Do you know how many sales there were? Okay. If I told you that there weren't any, would you disagree?
No answer. I don't know.
You don't know. Okay. Would a property that's losing $800,000 a year, as you say, as you show in your evidence, would that not be a significant investment risk?
The market evidence of sale in 2017 for 16 million showed existing price of market value of property in 2017. In 2021, we assessed 16 million 3,000. It's fair. It just slightly over. And plus 3 million was just investment for interior renovation.
Sorry, didn't you on an earlier question answer that you were not aware of the details of the sale in 2017? Are you now saying you can rely on it for cap rate?
I talk about sale. It's in 2017 open market.
Those are my questions.
Thank you. Gail, any questions?
Just in regards to the vacancy loss then applied of 11%, for the city to apply a vacancy percentage higher than that, what would the city be looking at to consider significant vacancy? Like, when would you deem a building to have a significant vacancy that would warrant a higher vacancy percentage?
If yes, if for example a building completely vacant under renovation, it will be 25% maximum empty building. But if you look for existing vacancy in 2015, 8.3%, 2016, 10.3%, and zero vacancy in 2017. So it's normal market of vacancy for this building. 11%, it's fair. It's just one 2 years problem, not problem, just current vacancy of tenants, but nothing wrong with this property, no structure damage, nothing wrong that it will be not occupied soon. And vacancy usually average 10 years at least.
So it's considered
some problem with
turnover?
Yes, it's
regular tenant turnover?
Yes, if something significant problem with the building and we know it will be never occupied, this space we apply overall vacancy more higher. But with this building was sale for 16 million, put investment 3 million, it will be occupied soon. It's no problem here. It's 11% we giving if they occupy more. I already mentioned few years was zero vacancy, but we still give around 11% straight 10 years in a row to cover it what happened right now in the building.
Okay, so does your system show in regards to the building permits that you mentioned of over $3 million that are noted in your material filed, and you mentioned them.
Mm-hmm.
Do those building permits relate to the area that is vacant, or do you know that?
We can see a specific on, it started on page, each permits has special, on page 21. For example, first permits 50,000, when landward work, demolition only, interior and alteration, or 32,000 square feet on 4th and 5th floor of multi-floor building. It was happened in 2020. And permit on 22, page 22, it's around 1.8 million interior exterior alteration. Landlord were to prepare for future tenant fill-ups. So building under already renovate. Interior work include new mechanical chases in concourse, removal of wall, new doors, new floor in former high well, and new partition. So it's money put inside building. It will be occupied any moment. So it's not a problem for a vacancy. Nothing wrong with building.
Okay, thank you
And
very
all this renovation was finished before reference date 2021.
Right. Thank you very much. Thanks for your presentation. Those are all my questions. Thank you.
Thank you. Bob, any questions?
I have no questions. Thank you.
And I have no questions. Thank you. Okay, Rocky, you can make your presentation.
Thank you. Now earlier I was worried about which version you're looking at. So if you catch something on it that's not on yours, let me know. Starting with page 1, all of our information is right up front for you. 69.38% vacant. Now, the sale the assessor spoke of was between Bank of Nova Scotia and the current owners. It was a leaseback, and both parties were aware of it. It's certainly not at market value. Scotia wanted to dispose of the building, and they were willing to enter into a lease. That happened in 2017. The bulk of the leases expired in 2019. They did keep their bank on premises, but not the rest of the offices. They all moved. And so when the person purchased it in 2017, they were aware a vacancy was coming, but at that particular point in time, they had a plan in place for the use of the building for a great part of it. And that plan did not materialize. So in that respect, the investment did not pan out. When we deal with chronic vacancies, generally, and I've heard assessors say this, they say generally they answer 3 years, and I don't necessarily disagree with that. So those 3 years are 2019, 2020, and 21. 3 years in a row, and it's still bad. And what compounded it worse is that the market vacancy was going down or up at the same time as of March of 2020, and every indicator in the market, so every marketing company, every brokerage firm, the Johnson report, they all reported exactly the same issue, and we all know why. It was as COVID came, the concept of an office downtown was changing, and the vacancy on the Bs, and I think we've got it somewhere in our report. I'm just looking at a different copy of it. Rose remarkably from 8% to 14.2% as just the market problems, not including the specific problems of the building. And that's why we're at a 25%. The backfilling of the building, they do have the G3 space, and there was hope that G3 was going to take a bit more space, but it costs money to bring those people in. It's not free. And when I was asking the assessor questions about IFRS, and it's in my rebuttal material, and I've sent an awful lot of it, but I can take a 50-page document and shorten it to a couple of sentences. The standard for accounting in investment properties has changed. You don't take the income coming in the front door and use it to pay back the tenant improvements you do. It goes into a different account. Capital gets replaced by capital. Investors would be misled any other way, because every time a tenant changes, money's got to be spent to do changes for the new tenant. It's an ongoing process. Also in the rebuttal material, we'll show that the method of valuation is generally a discounted cash flow now. On a building like this, it would be a 10-year window with turnovers. This is the nature of the world. And if you don't follow those rules, if you're publicly traded, you can be fined heavily by Securities and Exchange Commission for providing a misleading statement. So I was asking questions about the theory that the assessment follows, and it's still rather simplified, but it's not in the world, not in the market. In the market, you've got to play by rules. You will see later on another example of one where the rules are followed quite clearly. So if you make money from your TIs and it's already included in the rent, it goes back into a capital account. Now you can declare the money you made on it for the interest. That can go to your building income. It's a question of whether or not it's taxable or not, but the investor has to see that. And anything that's put in, like I said, you get a new tenant, you look at the term, and at the end of term, you're going to have to pay it all over. It's a recurring expense. So it's a rather the approach being considered by the assessment department is rather simplistic and not representative of the market. You'll notice that on page 4, where we do list the G3, you'll note that yes, indeed, it's a 10-year term. So they come in, the owner's got to pay some money to fix their space up for them. 10 years from now, they say, well, we're leaving. Oh, unless, by the way, you want to spend some more money and we need upgrades now, or we need replacements, and they spend it all over again. That's what's missing in this calculation. Now, theoretically, one of the ways of dealing with it is to put on applied rents. And the assessor, to a degree, has done it on their model. But remember, what goes into making their model are the rents that are in error to begin with. What we looked at was clean rents. So we provided a whole bunch of leases, and some of this stuff is, let's just call it having some fun with theory. There's several pages here of some stuff from the municipal board about what represents a lease, calculation of a fee simple lease, which isn't what we should be looking at on that basis. But there's a great amount of detail in the rents we presented, and the documentation and the rebuttal information. So we did end up deciding on $13, and the greatest weight on it was actually based on the idea of weighing out the costs and the repayments, and determining, and you'll see this in the rebuttal, is our company does majority of office leases in downtown Winnipeg. And it's always a question of what's the face rent, what's the TI allowance, what's the repayment schedule. And we ended up at the $13, which is net in the owner's pocket. The rest of it is repayment, so it's not income, and it can't be treated as such. So that's different. So I've highlighted the two differences. One is the calculation of the rent. The second is the vacancy. It is a chronic vacancy. 3 years it's been in place, 25%, which is what the assessor brought up as well. We're not in disagreement with the answer to that question. On the non-recoverable side, you can see that questioning indicated $1 million in shortcomings, non-recoverable. Now, the concept of the non-recoverable, it's not a single year event. It's an average. So if you see going all ahead to page 51, we actually studied this building a great deal and to calculate the non-recoverables. And about 2/3 of the way down, we had 4 consecutive years of non-recoverables in the building. And during Bank of Nova Scotia's tenancy, 0.56%, because it was full. Then the next year, we had Bank of Nova Scotia moving out. We had G3 moving in. We had calculated at 33% for that year, 33% for 20, and post-reference, but this is only to confirm a trend, stabilized back down to 1.07. So what this is telling you is that we've got about approximately 66, 67% over 4 years. So that's going to be 16% per year of non-recoverable costs. This is a bad building. It had a bad time. It had a complete turnover. Now we're only looking for 5 and 2% because we're not expecting that all their problems are going to be addressed by an application of non-recoverable. It is a market-driven factor. They may have 10 years of smooth sailing at 0.5% again. They may not, but this is how the market deals with it. And again, going back to the IFRS standards, it's International Financial Review Standard. This arose out of Enron and Arthur Andersen's bankruptcy, where the securities commissions and investors said, enough, we're not dealing with misleading statements anymore. We want to know actual revenue that's coming from your actual rents. We don't want to see money moving around and you trying to claim it as income. That was the story of it. That's what I'm trying to get at rebuttal. So and it's possible that in 10 years' time, the tenant might renew and not ask for any money. And then at that point, it's all net revenue coming in because cycles change. But we're in a really bad cycle. And the legislators were clear when they wanted a 2-year window because to account for changes in market. On an aside, I just noted that Nelson Carpa has now joined the municipal board. From his experience in Calgary, he's going to know an awful lot about changing of cycles on office vacancy. They're like a yo-yo there. But Winnipeg's never had this, and now we do. We have a migration from downtown. It was a trend that was already started, and COVID made it worse. So our issues on the valuation are that now we're capping at 7.5 simply because there's no optimism in this market. On our page 49, these are sales generated from a software called Sabre. It's supported by the Appraisal Institute, the Realtors, and the City Assessment Department. You'll notice that the puck codes are all from the assessment department. I ran a very simple search, everything office, 1 year before the reference period. I actually picked the first day of COVID when the first announcement was made up until April 1st. Not a single valid investment sale happened in OF. And the fact, this is a really simple thing to explain. When the market's dying on any commodity whatsoever, people don't want to sell because they're hoping for a rebound. Unless they're desperate, they will not put their product up for sale because they're going to suffer a loss. They're going to sit and wait. You could do it whether you're selling a car, a pair of boots, or an office building. It's very simple thinking. The only sales that happened were suburban sales, and you can see that they're loaded with suburban sales, and that's the migration to the suburbs. With owner occupiers wanting to move closer to where they lived. No, the downtown was history. That's the bulk of the main evidence, and I do have some rebuttal I'd like to go over, and I'm going to be quick on it.
Well, let's go over any questions for your main brief. Svetlana, any questions?
Yes. It is true. You state that sale in 2017, a new owner was aware of future leave of huge tenants and still bought this property for 16 million, correct?
What he was really aware of was that he owns a call center. And this was to be his home for his call center based upon some contracts he had coming. Those contracts never materialized, and therefore his 2-year window for backfill did not happen. So it was a mistake on his part to make that purchase. Well, not a mistake. It was a business reason that didn't pan out.
But it was sold for 16 million and still. So owner was knew about future vacancy and he put extra 3 million for renovation of existing property. So
No.
no any issue with vacancy
No, that's
for,
not what I
for
said.
new owner right now.
No, that's not what I said. He had a contract coming up, which was going to be happening in the near future. That future was estimated at 2 years. They made an agreement for a 2-year lease, so he had stable income, at which time he had anticipated being able to convert it to his own use. That's the use that never occurred.
Okay. Do you have any evidence to support your statement?
All of my information comes from firsthand knowledge and speaking to the owner. I spoke to the vendor, I spoke to everybody, and I confirmed it all with them.
But we don't have any evidence in your brief to verify, correct?
I'm under oath. I'm swearing to firsthand information. It's not like answering questions about a model, which for the last 20 years, no one's been able to do.
I think we've heard enough about the sale.
Okay, let's open page 9 of agent brief. What office rent comparable support subject leases? Subject rent, market rent.
You're saying page?
On page 9 of your brief, what comparables you rely on in your estimation of market rent?
I'm wondering if you don't have a different version. Let me just see.
Well, quite frankly, on page 9, we don't know what type of office building this is. There's only 4 indicated. A class D, a class, and 3 class Bs. So I don't know how anybody can answer this question.
Oh, on this one, this is a listing of mostly suburban rents, and what we were relying on was okay, so that's a different statement, a different one. I'm just figuring out where it was. There was some information. What happened on this hearing is that we had apparently 2, now 3 deadlines for submitting evidence. So some of it was submitted under the basis of rebuttal. And I'm just looking for that right now.
Well, we can only look at the evidence before us.
No, but I'm saying that the information that was filed, our first deadline to file information was October 4th or something. That was then changed to December 28th for the January 11th hearing. January 11th hearing was not supplied with the new evidence submission at all. You're supposed to use the same evidence from the 11th. So there was some information that we filed on December 28th for that hearing. And I'm not exactly sure where it ended up.
Right now, we're looking on your evidence submitted prior. Right now, in our case, I have a 14-page document, correct?
No, 14 page.
Let's not look at what was submitted before for the October
Just
hearing.
current. Let's
The only
look
thing
on
we have
current.
today is in front of us, period. Pure speculation as to what was submitted at the first hearing and what was submitted for the second hearing. But
Well,
today, what we have today, and that's it.
I do have all the emails which confirm what was submitted, and some of it was resubmitted this morning.
This morning.
Resubmitted, but I don't have. I can find out the date on this on December 28th. Confirmation.
Rocky, it's not relevant. We've only got the documents that we have today.
Okay, but I'm saying I did submit it on time. I can't control that the hearing got changed twice. And
I can't control that either.
Okay. All I'm looking for is just an understanding of the mess that happened. That's all. There is information that was submitted. I'm looking at here. Your evidence has been, here we go, your evidence has been submitted. And, oh, that's December 12th, I'm in the wrong month. We do get all these confirmations from the board about our evidence submission.
And that's fine, but the only thing we're looking at today is what's right in front of our eyes.
Okay, but I can't control people putting it in front of you. You know that.
Well,
Okay.
I can't control it either.
I'm just looking, what's the schedule of this? 1852.
We're wasting a lot of time for evidence that is not before us and may or may not exist. I don't know.
Yeah, okay, well, that's my answer to it.
So your page 9 of your brief presented in front of us, several comparables doesn't support your subject property, correct? We have to ignore this page.
Well, the report that was submitted for sure is actually the evidence submitted on page 7 and forward for rents from a different building that the city had provided, and they're all listed there. It was for some municipal board appeals and some calculations.
So a table of comparables on page 9 we have to ignore. It's not support your subject property downtown B office, correct? Yes, no.
No. See, the thing is, you're looking at a different version of the evidence, which I don't.
Everyone looking on same evidence.
It was resubmitted. Page 9 is from a municipal board hearing from November 4th, 2020. Is that the version everybody has?
Yes, but it's not relevant, but.
Well,
let's open page 5 of your brief. You present in case management report without prejudice, correct? It's not supposed to be shown anywhere. It should be removed completely from your brief, correct?
Yeah, I don't know about that.
Without prejudice, it should be never showed our public record, correct?
I'm not putting any weight on it at all, with the exception of this reproduction on page 6 has been put into every City of Winnipeg assessment brief that was occurring. So I was just showing that this was what a site-specific Class B rent was calculated at.
But this document without prejudice and it's my preliminary issue should be removed for brief from public view.
Atlanta will place the appropriate weight on it. Any
Thank
of this evidence.
Right. But
let's open page 7 of your brief.
Page 8 Page 8 has the same information that was published and introduced as evidence at a hearing. So you can disregard page 6.
On page 7, you showed preliminary issue for Municipal Board of Manitoba for 125 Gary Street.
Say?
It's on page number 7.
That's of no relevance to us.
It's not relevant because it's for 2014 assessment years. It's not relevant.
So
we don't have, you didn't provide any evidence to support your estimation of subject property market value, correct?
No, what we did here was we had a building that had negative $800,000 in income. And when something like this occurs, we were looking at a method that the city assessor decided to apply, which was to determine in their concept what a fee simple was. So that's what pages 9 to 14 are an indication of. And we also had on page 59 asking rents for the year for Class B. And
We
they
don't
were-
have page 59 in front of us.
Sorry, page 19.
And only 14
Yeah,
page
you don't
brief.
have page 19 in front of us either.
Page 19.
Only 40 pages brief.
Okay, well, I've got receipt that this was submitted on time, so let me see if it's on a different, earlier one. I don't think one can hold this against us for doing. This was submitted on time. So,
Well, you know what? Before we continue, we're going to take a 10-minute recess and we're going to put this to bed.
Okay, thank you, Mr. Chair.
Thank you.
We are live, Mr. Chair.
Thank you very much. We'll reconvene the hearing this afternoon. Rocky, I just have one question to ask you. On your most recent submissions, was there any change in the value that you requested for anything?
Don't think so, no. Let me just double check that. No, same number.
Same number, okay. And I just want to make a comment that both parties, we want to get through this in a timely fashion. Don't keep asking the same question twice, number one, and number two, we can read. We have the briefs and we all have it well in advance of the hearing. Okay, so where were we?
Which one are you looking at though? Because I know there are at minimum two versions of what we had out, and I've already told you there's two versions of the assessors. I just want to know what you're reading so I could try to make it easier to follow.
Well, on the first one, we have a 14-page brief from you.
14.
14.
Okay, I see which one you're looking at.
And that goes without saying for the rest of them.
Okay, so this was the one that was submitted October of 2022. And then there was another submission which was I'm looking at a date on it of January 17th. That's the one I was reading from. And the January 17th one is the same one I'd asked the clerk to send me a copy of the assessors. So I know it's a nightmare here. I don't know what to say. I know they were filed, and I guess somewhere in the confusion of the dates being changed twice, that what was put into your folders may have been differed from what was the final.
Well, we can't tell because we don't have them.
Right.
So we're going to go ahead and proceed with this hearing based on what we have. But you confirmed that there's no change in the value you're requesting. And Svetlana, can you confirm there's no change in the values you're requesting?
No.
Okay, so let's move on. So
I have records that for same hearing scheduled on October 19th, I did submit evidence. I didn't receive agent evidence. I did submit new evidence prior to January 11 hearing, what I am rely on, and I received agent evidence prior January 30th. So it's new evidence for today hearing.
well, I'm not sure why you were allowed to submit new evidence for a hearing that started in October.
Well, we did have a letter saying we could.
Oh, okay. Well, that's something that I haven't heard of.
Yeah, I can send you copies of all the letters, but this is where it all started.
We're gonna continue on based on the evidence sitting in front of us.
Can I continue with cross-examination?
Yes, but be brief.
Very brief, yeah. On page 13, you provide Colliers Management Expense Study effective January 17, 2022. It's post-reference. It should be removed from your brief.
No, you're incorrect. That's when I printed it. Read the numbers, statement date.
Yeah, that's nice, but we can't read the year.
No year at all.
No,
Just-
the years are all there. The first one, 2017, December, 2018, December, 2019, April. Look at the first number is the year, the second is the month. I
Well,
put that there.
On page 13, 14, we have income statement examined.
I
for
put-
several properties and effective August 17, 2022. That's it. It's post reference and all these 2 pages should be removed from agent brief.
In that case, all of your evidence has to be removed, because if you look at what you wrote up,
Okay,
on
that's
here.
enough.
Well, you know what I'm saying. That's ridiculous.
I know, because a statement date, we don't have years. You have, yes,
He's
day
mentioned the
on
exit
months.
land.
That's it. I don't know what years is it.
The only one you
verify.
can remove is
Uh-huh.
the one for 200 Portage, December 21st.
Yes,
Should be removed.
absolutely.
Because I don't see any years of statement date. How report was submitted.
The-
17 December,
let's
that's
move
it.
on.
Second property, 16 December, that's it. It's not useful at all. It's I don't have any question because no any evidence to support agent value estimation. Thank you.
Okay, that's fine. You're done with questioning?
Yes, I don't have question, no to chewing on. It's nothing to submit to us. Rest should be removed.
Okay, now we can go to the panel questioning. Gail, do you have any questions?
Just Rocky, in regards to the vacancy that you're proposing, 25%.
Yes, that's correct.
So you're saying by applying 25%, that's the highest the city ever applies. And so you're proposing that it be 25% and deemed as a chronic vacancy, right?
Yeah, that's correct. And it's the city coincides with typical market practices that at 25%. Once you go past 25%, you should be questioning your highest and best use because it's not generating enough income to be an office building anymore. And that's the reason we often go to highest we can go is 25%.
Okay, and okay, thank you for that. And my other question is in regards to the cap rate that you're proposing, 7.5%. So like that's at the top of the range in the studies, right? So
well, in our range, and yeah, went over that a bit too quickly. And I have to find the 14th page report here. Okay, well, in the report that was submitted, the other report, we had the Collier's breakdown of our ranges, and we use a base rate of 6, which is the best building. Our high end for this would be for a typically performing building would be 6.75%. And then we adjusted that for the deficiencies on our second page. That one's consistent. And the issues with it were listed there. The difference in our cap rate style. It's not a new building. It actually suffers from, and I didn't do this, the design and layout. It has a center courtyard that's open to the floors below, which is horrible for putting floor plates in, and it never made it into the evidence. I apologize. I'm not doing these, but I think that the 7 point, it's just a poor layout. Then it's the downtown office, which is getting worse over time, not better. So the future, like a vacancy, is an expression of what's happened. About high cap rate is your expectation for the future on the effective date. So April 1st, 2021, the future was worse. It like there's no upside to it. You had vacancies, but in a normal market, you'd have potential for recovery. April 1st, 2021, that potential went away. And so it's a removal of any optimism would be the best way. The True North Square had come in, and if anyone wanted a premium space, that's where it was going, and that's where the bank went. their tenant went, coincidentally. So it's just Portage-Main declining, no control over their own parking, issues like that.
Okay, okay, thank you very much. Those are all my questions. Thanks for your presentation.
Thank you. Bob?
I have no questions, thank you.
And I have no questions. So Rocky, do you have a rebuttal to this?
Yeah, and I had general rebuttal, and let me just quick. I'm looking for it as I'm stalling for time here. I'm not gonna read any of it. I just with the unusual situation we have. So the first one is marked income and expense mailer, and there was a question. This was a result of the verbal testimony of the assessor, unsure about the situation on the purchase and the tenancy. So this shows on the third page.
What's the document entitled?
Income and expense mailer.
It's labeled as a file number and the applicant rebuttal, Mr. Chair. 22-3067 applicant rebuttal.
Got it.
I don't have this rebuttal. Please provide to me.
I sent you an email, Ms. Chabal.
Okay, I don't have it.
You might have to refresh the SharePoint.
Oh, okay. Oh, I have it now.
Page 5. It's just very simple. The building was sold. Bank of Nova Scotia sold it to the current owner. Took out leases, the date of the sale. One is a 10-year lease on their bank space, and the other is a 2-year lease on 48,000 square feet of building. So just to be clear, I was asking questions about the nature of the sale. It was a pure lease back. Don't put any weight on the sale. And this was the window, that the first window of 2 years that it was going to be done. And the assessor asked, did I have any evidence of this? Well, here it is, right here. The next document is
Well, let's see if there's any questions on this document. So Atlanta, do you have any questions?
I don't have this evidence. What I see with battle working from home during the COVID.
No. The latest email I sent you with.
When? I don't have rebuttal. It's my point. What day you send it?
Just 1 second. Just today. I just send you 2 emails at.
It's a email from 2018, whole years. I don't see point for 2018, for 2021 assessment. How it's relevant?
Are you asking me or Mr. Neufeld?
I try to find rebuttal. Okay, working in COVID. Which more? I don't see it.
I sent you latest email at 2 p.m. today. It says applicant rebuttal file 22-3067, and the other one's applicant rebuttal applicable to all files.
Okay, found one. I found one 2018 income expenses mailer.
Yeah, that's the one he's asking.
That's the one.
Okay, but it's 2018, we in 2020 full years of estimation. How it's relevant? I found Manitoba law, Municipal Assessment Act. What I should find more?
No, it's just a 6-page document.
And we're looking at what, page 5? Of
Yeah.
this 6-page document?
Which is the
Which
same
is the
document.
master rent roll.
I'm sorry?
It's
It's
the
the
same
master rent
document
roll.
that's, I'm sorry, that Svetlana had in her brief.
Oh,
So I'm not sure, Svetlana, what your question is.
I don't know what rebuttal we're looking on. I could not find them to ask questions.
Well, this is the same document that you had in your own brief.
In my brief, it's income expense matter for 2020, and
No,
I
you also-
found
you also had
rebuttal
the-
to. Okay.
You also had the master rent roll.
I can forward you the email again.
Okay, can you put in one letter, not over the place?
Yeah, I sent you
In
the.
my brief, we have income expense mailer started on page 12 for 2020 include. It's a full income expense mailer provided for us. What it's rebuttal, it's already in my brief. What I'm missing here, sorry.
Jazz, did you send it again?
Yeah, I just sent it again. Wanna check that email?
Yeah, I'm looking on my mail right now. Yes, I received something. Thank you. I will open. I still receive 2019 income expense mailer. What
Yeah,
I
that's
need to
the,
look into?
yeah, that's the one he is asking for.
Okay. What point? Why we need this information? Could you repeat, please, agent?
Well, he was quite clear on showing,
Because
when-
it's not relevant for 2021 assessed years. So I don't have any question on this document.
okay,
It's talking about a completely different market evidence. It's for 2020 assessment years.
okay, we're gonna move on. Gail, any questions?
I have no questions. Thank you.
Bob?
no questions, thank you.
And I have no questions. So Rocky, what's your next rebuttal?
Okay, now I had sent an email earlier in the day and there's just 4 rebuttals for files for all properties today. Again, I'm not spending a lot of time on it. I want to be clear why I did this. The first, do you have the 4? They're marked rebuttal, letter to Tim Austin, litigation letter, non-recoverable orders.
And there's a rebuttal IFRS,
Oh, yeah.
but you already spoke to that.
Oh, yeah, no, IFRS, right. That was too big to send by itself. You're correct. So in the order in my head, start with what's called the litigation letter.
Well, that's not in our, that's in
got
our
it.
list, but not first.
This one it says applicant rebuttal litigation letter, Mr. Chair.
Yeah, I haven't.
I have it.
You have it, Svetlana?
Litigation letter?
Yeah, there's 5 documents. I sent you another email.
Okay.
Yeah.
So do you want to speak to this, Rocky? I'm not sure what the point of
Yeah,
this.
I mean, it's just we've notified the city, don't use our cap rates unless you know what they're all about. They were put on notice in there.
Well, hold it here.
Yeah, it's
This
fine.
letter is going to the municipal board.
Oh, well, I did you read that part where I'm authorized? I'm authorizing it to be sent to you.
Well, the one we're looking at says.
It
panel
says,
user direction.
it says that I have the authorization to deal with it. That's what it says. But we're not gonna, you know what, you don't have to spend any time on it. I'm just putting in the proper foundation. Then we sent the same letter to Tim Austin later. called Letter to Tim Austin.
Yeah.
Got it.
yeah.
We just objected to the use of our evidence, of our report in evidence. That you can't use it unless you know how it works. And if you don't know how it works, the person they're supposed to ask is me. Apparently in the future, I will be writing this report, and not for any agenda reasons of my own. It's just, that's just the way our company works. Next one is,
Can I respond for this?
What's that?
Can I respond?
Well, I'm not sure what you're going to respond to, but
If you open page 10 of my brief,
Oh, God.
at the capitalization, its third paragraph, we can see 1, 2, and 3 apostrophe that capitalization rate further supported by comparison with real estate market report from Colliers International Canada, CBRE National Research, and Cushman and Wakefield. And on the bottom of this page, we can see where this information we take from what website. For example, first apostrophe, it's Canada Cap Rate Report, Valuation Advisory Service Colliers Canada, we took its public knowledge. So it's on apostrophe number 2, we took information from Canada Cap Rate Investment inside CBRE, it's public knowledge. And third, it's Bowman report from respectfully quarterly report on commercial real estate cap rate in major Canada market, Cushman and Wakefield. So it's public report, you cannot object by using them, it's public. It's our outside sources and we reference where we took this information.
And as usual, we'll place the appropriate weight on any evidence, including this.
Yeah, it's public report, and if you compare our information, Canada, Assessment Taxation Department, we can see downtown B office 6.75%, Colliers report highest 6.75%.
You know what,
CBRE.
Svetlana, we've all seen these charts.
Yes, and
Many times.
it's public report and we reference where we took from. So this letter doesn't make sense.
You made your point.
if somebody says something defamatory in public, just the fact that it was released to the public is not a defense. It's still being misused. Can I go to the next one?
Which one is that?
Called just rebuttal 6 megabyte or just rebuttal.
I don't see just rebuttal.
It'll be rebuttal applicant.
Yeah, got it. Rebuttal dash applicant.
Yeah, and this is a lot of pages, but the red charts just block off the dates that we're looking at, and they're talking about the change in trends to work at home. This is what's killing the vacancies in our downtown office. And just statistics, the assessor has failed to consider these statistics in their valuation, to assume that everything is fine and wonderful. It's not. We all knew, and I've just to avoid the mistaken complaints about the dates, I've also red marked the source date from the information. There's not a it's we don't talk about hearsay. This is, we also on moving ahead to page 34 is a news story, and my source for information, there's his picture. That's Sean, who does most all of our downtown office leasing. He is my source, and he's writing stories about how, or he's discussing stories of the conversion, the vacancy rates that have happened, and it was published post-reference, but when one reads the information, you'll note that he's referring on events that have already happened, not events that had happened, and the enormous amount of buildings that are being repurposed. And that includes, there's some reference to the Bay, although it's retail. what's interesting about it is, again, repurposing of the downtown. And another story on how this is happening across the country, starting at page 43. And I have earmarked the source dates for it. For example, that story, page 46, began in a study in 2019 as to what's happening. I'd asked the assessor questions about building class, and on page, this document is rather interesting, page 48. This was prepared by Ken Croach for the City of Winnipeg Assessment Department over 20 years ago. Ken sold his report to Wayne Johnson, and it is now the Johnson Report. This forms the foundation of building classification for the report, and it gives you an idea of the variances. So on page 51, he actually has the ratings. This has been in the city's possession for 23 years. We attempted to, I knew it existed because years ago, Ken told me about it. And I tried to subpoena it, and they said they didn't have it. And eventually I found this from a different source. But on our page 51 is a breakdown that shows you where everybody gets ranked. And you can see that for 200 Portage, it's Scotiabank, so it's ranked as a 24. And when you compare it to some of the other properties you hear, you can then get an idea of how it fits in to as a comp. And his rating points are all explained. So 155 Carlton is marked as a 23. That's got to see if that changed with the Skywalk, because this was dated before the Skywalk went into a lot of places. And 191 Pioneer is rated as a 16 Class C. So that's where Ken put it. I'm just looking for 330 Portage is a 22. And this is before the arena went in, so that would have changed. Just an indication of that there are numerical ratings out there. They all differ. And I have had an excellent chance to speak to Ken and Wayne about this. On page 55 forward, there's the IFRS introduction about how things work and the objective of the financial statements. And what I'd asked the assessor if they follow IFRS. Well, they do not. For example, page 57, is it probable that future economic benefits will flow to or from an entity? So that takes into account the periodic payments for repaying loans on TI. They don't do it anymore. For example, the concept of capital maintenance, will it produce a permanent change? And one has to be able to prove it, not simply make a statement that, yes, we're making the building better. So boxed off page 59 is showing you that there's different cash flows operating, and that's from revenue producing. Investing cash flows, which are money that come from tenant improvement repayments, and or financing cash flows. So that it's now has to be reported separately. And that's not to say that the income can be disregarded, but you have to report it separately so that you're not misleading the public. That's a short-term version of it. There is in here a lease, which I'll talk about later, for 330 St. Mary. And that's why it's included here. Also, there is, okay, I'm not going to cross the line here. I don't, but I believe that this had been submitted in our evidence. So I will speak to it very briefly, and you put the weight on it you'd like. But you'll note that 330 St. Mary, this is an analysis done by another assessor for the same reference here. And you can see that these are copies of what the assessor has presented today. And
What page are you on?
I'm on page 73.
Okay.
So we have 330 St. Mary. And what were the other ones that are on here? 330 Portage, 200 Portage, 333 Main, and 191 Pioneer. Now you'll notice the bottom of page 75, these are Sean Cleaver's notes. One tenant. If NTS leaves, this is 100% vacant. I asked the question, the assessor didn't know the answer. Sean knows the answer. Same with 333 Main. That is 7 floors that were vacated by MTS available on sublease, but it doesn't show up in the vacancy because they're still getting money for it. And the other properties that he went through, he pointed out the error in 200 Portage. It's wrong. He circled it. He says it's higher than that. And 155 Carlton, you'll note that his number on it is not 3.2% as the assessor states, it's 13%. He knows because he's trying to lease the lots, and he knows the effective date, April 1st, 2021. So this is our report on it. And on it, the guy who's actually doing the leasing on it has responded. There's some others here, and since they haven't been addressed, no point discussing it. But the summary that Sean provided is page 77 on what's happening as of April 1st, 2021 about face rates and TIs, and a general comment on the market. The cap rate is repetitive. You've heard it all before. Page 91 is from the textbook for the Appraisal Institute. Exclusions from reconstructed operating statements. When I said this earlier, I'd asked the assessor questions about IFRS and TIs, and she said the model takes it all into account. Well, the proper theory is quite clear. Loan payments are not income. A tenant improvement loan is a loan payment. Now, we're not looking to have it all excluded, but there has to be a reconciliation that's accounted for. And more discussion of the loan payment issue on page 93. So I'm just trying to show you how theoretically we're following what we're supposed to follow. The management fee on page 96 is regard to non-recoverable costs. And what I found very, very interesting about this is that it's the market standard for the site that sets whether or not there are going to be management charges and non-recoverables. And in the market, the people who set this are not assessors, they are market participants as to the inclusion of it. And in our market, they are non-recoverables. I've referred to this a fair amount, and I haven't really provided this all because it's really a bordery. But that's where it comes from. There's some verification stuff in there, which I just never bothered here. On page 105, this is from an article written in the Appraisal Institute in the United States about management fees. And management fees are often neglected by appraisers as well, and it's true. This expense is for the administration of the property. Someone must collect the rent, et cetera, et cetera. The true test of a net return is to assume that the investor is from out of town, and then one must rely on local management to provide the best return. So this is the concept behind it. And here's our expense study recreated again, and it was, I think that this might be updated a bit from the last one, but and the numbers, the last one that was printed clipped off the median. The mean was 9.81. I'm looking at the bottom of page 111. The median is 7.01, which is exactly what we were looking at. And then the last page is just a regular Municipal Assessment Act regulations. Just to remind everybody, we operate in 2, sometimes 3-year cycles, and values change. They go up and they can go down. It doesn't flow in one direction. The next document is going to be
Well, let's deal with this one first.
certainly.
Svetlana, do you have any questions?
I would like to object of presenting new evidence during hearing. All this information new. It's not should be considered. By the end of the day, we have evidence 14 pages only. All this new information presented for us during hearing, object of it.
You've made your point, and the board will make its consideration.
So
Gail, any questions?
no questions because it's new information. Sorry.
I'll ask her questions.
Sorry.
You're not running this hearing. Bob,
No questions.
and I have no questions. Okay, Rocky, what's your last document?
No, I got 2, but one's long, but yet it's going to be short. It's marked the IFRS.
I thought you talked about that earlier.
Yes, I did. But this is it's a more detailed story, and that's all I'm saying about it. It just talks about the differences of what's happening on treatment of income.
Okay.
And lastly, unless there's a question or 2 or none.
Any questions?
I have no questions, thank you.
I have no questions. Thank you.
Svetlana?
No question for new information.
And I have no questions.
The last one's called non-recoverable orders. Now, I'm not out to compare assessments here. Be clear. When I'm out, I'm talking about procedures, not numbers. But in a very brief way of explaining it, I heard Rob Slaughter had told me about some properties and how some boards are applying the non-recoverables and some are not. So he told me about these, and what I found of interest is that they include 1, 2, 3, 4, 3, 2 buildings that are attached to the Portage and Main, as well as the assessors, 333 Main and 191 Pioneer. So it's interesting, the assessor said there were no non-recoverables there, but yet the board decision was based on evidence presented by the appellant, which is, I told you, I asked Rod, what did you present? It's just of interest. The other ones that are connected are 201 Portage Main and 220 Portage, and evidence by the applicant, which is of course the 7%. 201 Portage is quite clear. It's 7% non-recoverables. So I guess the point is that there is mixed interpretation of boards, and I'm not suggesting you have the responsibility to act independently, of course, and you should act independently. We're going to be dealing with incredible problems in the future for any property that goes to appeal, and when is equity going to happen or not? It's not an argument. It's just that there are divergent views on it, and I wanted to show you those. That's all.
Well, and you know what I say to every here.
Yeah. Oh, I anticipated the response 100%.
And I'll make another comment that assessment is an estimate of value. It's not an exact science.
Correct.
You agree with that?
Absolutely. And what I'm saying here, though, we're not talking about opinions of value. We're talking about procedures, and there is a difference.
Well, you still know my thoughts on it.
Sure. Yeah. No. And I guess the goal here is to try to resolve all these and not continue to have to deal with this for the next 6 years at the board. That's all. Sorry. Yeah, we can move on.
Atlanta, do you have any questions? I think I've answered it.
No questions for new
Yeah.
information.
Gail,
No, I have no questions. Thanks for the information.
Bob,
No questions, thank you.
and I spoke my piece. Now, can we get back to the regular docket?
You bet.
Okay, the next property on the docket is 330 St. Mary's. Any preliminary issues? Either party?
What are you looking at as your document?
The one that was submitted by yourself.
Oh, no. We submitted two. I'm 100% sure of it. I'm going to have it before the end of the hearing, our receipt for it. I'm asked Bram for it. I've got it.
What do you want to know?
What? Okay, how many pages is the one you're looking at?
14.
Okay, wow.
And that's what we're going to look at.
Got a 12-pager?
What's that?
I'm just trying to find it. You sure 14?
Well pages. We received prior to this hearing only.
Oh, sorry, 12 pages. I was looking
Wow.
at it.
Okay.
Yeah.
Okay, Svetlana, any preliminary issues?
No issues.
Okay, you can make your presentation.
File number 22-1852, roll number 120-9340150. We are valuing the property as it stands of January 1st, 2023, based on the economic condition April 1st, 2021. This appeal with respect to the to the amount of the assessed value only. Based on the evidence in this report, in this assessor opinion, that the market value of subject property as of April 1st, 2021 is $27,631,000, and that the 2023 assessed value should be confirmed. The subject property is office building located in downtown, built in 1979, with a leasable area of 147,000. On page number 2, we have subject property sales. In 2012, subject property was sold for $26,066,360. On page, same page, on page number 2, subject property leases. We can see that leases between big area of 26,129 square feet lease for $13. In SO4, you can see, I don't have to read it. If you look on page number 3, total revenue base rent, potential 2.47 million, plus parking rent. So reported rent area, with reported rent area 163,430 square feet. This base rent give us average rent in the building, $15.12. Estimate rent rate, what we use for our property, for this property, 146,900 square feet, give us estimated rate of $16.82 per square foot. It's for 2020 reported income. On page number 3 and 4, air photo is street view of subject property. It's located rectangle shape of land. On page 5 and 6, same OB market study analysis of similar properties. 330 St. Mary is our first property. It's subject property. We can see that average 3 years rent, $15.67. Vacancy reported average 6.6%. Shortfall $12.83% for 3 years. Not recoverable expenses 0.7%. Oh no, yeah, 0.7%. And 240 Gram, 444 St. Mary Avenue, 220 Portridge, it's our comparables. What they showed, average rent for 240 Gram, $17.50. Vacancy in 2020 was 18%. Shortfall was average $8.92. Not recoverable expenses 0.6%. Another comparables 444 St. Mary Avenue. We can see average rent $14.43. Vacancy 9.3%. Shortfall $16.88. Not recoverable 6.6%. 220 Portridge Avenue, average rent $16.04. Vacancy 23.5%. Shortfall $15.68. Not recoverable expenses 1.3%. And 161 Portridge Avenue, stabilize rent $13.94. Vacancy 20%, a shortfall $14.89, and not recoverable 5.8% for 2018-2020. OB market study showed that average OB $14.35.
Lena, are these the same
Okay.
charts?
Same chart, yes.
Then all you have to do is request that we take it as read from the first property.
Thank you, please do it. So first, for market income, we estimate parking structure. Subject property has a 65 heated parking. We use monthly net units rent per stall, $103.50. So annual net rent, $18,730. We apply 7% vacancy, so our estimate value for parking structure, $1,153,000. On same page, provided comparable property 2020 reported rental rate for parking structure. You can see that stabilizing net not operating per stall per month range between $135,000 per stall to $52 on 393 Portridge. But we need to look for heated one. So we apply $103.50. Comparable property actual gross parking structure rate on April 1st, 2021 on page 11. 330 St. Mary, do we have here? 330 St. Mary, I don't see it here. But yes, it's a comparable 26. We can see 330 St. Mary, they reported 43 stall heated and monthly rent between $278.25 to $304.50. The subject property has parking lots on page number 12. It's 23 stalls. We apply a $92 monthly net unit rent per stall. we apply 4.5% vacancy capitalization rate for parking structure. It give estimate value of parking structure 564,000. Below comparable property 2020 reported rental rate for surface parking. It's 14 comparables with median of $92.24, and we apply $92. On page 13, presented income stream of office building class B. We apply 146,898 square feet at $15.32. We apply same vacancy loss 11%, expenses 3%, shortfall $12 per square foot for vacant space. In our capitalization rate 6.75%, give an estimate value of $25,914,000. Summary, income summary for 3 different streams give us $27,631,000. Below this income value stream, reported net income $2,062,000. Our net income estimate only $1.8 million. On page 16, capitalization rate table, market evidence supported City of Winnipeg Class B downtown offices 6.75%. On page 18, started income expense mailer provided for us for 2020 years. On page 29, 30th, it's subject property actual rates of April 1st, 2021. On page 32, started Johnson report of vacant space. So based on evidence and this report, the subject property value as of April 1st, 2021, $27,631,000, and that the 2023 assessed value should be confirmed. Thank you. Any questions?
Thank you. Rocky, any questions?
Yes. I lost your screen here. Okay, yes. Page 13, 14, 15, were these all done by the model?
Correct.
Now you did some calculations here on page. Oh, sorry, I'm getting the wrong order. I'm back to page 2. You list the sale in 2012. Can you confirm that that was a sale of 4 properties?
It's a subject sale history reported.
Can you confirm
Around 26 million.
Can you confirm it was a sale of 4 separate properties, 4 separate roles?
It's for this rolls number. We have 6 sales recorded against this
Are you
property.
aware that the sale was for 4 properties and it's in the rebuttal material? If you're not aware, that's fine. We can move on. Were you aware?
Sell. Sale in 2012 for 26 million between St. Mary Hargrave nominate Inc. to IG Investment Management Limited, instrumental number 4246726 for this against this property, yes.
So is the answer yes or no?
It's for this property to 330 St. Mary, sold for over 26 million. And we asked in 2012 and we assessed in 2021 for 27.6 million. It's fair.
You aware that all of your colleagues have recognized that it was a multi-role sale and not to be relied upon?
No answer.
Yes or no? Were you aware?
I don't know.
Okay, that's fair. This rent roll on page 2, did you prepare this?
Subject property leases.
Yes.
It's from 2020 income expense mailer provided to us.
Did you prepare this?
It's existing leases. What your questions?
We make the rent rolls up and it's not our work. So did you do this work?
It's a record and I took it from our records.
Okay, that's all I wanted to know. And this calculation of rent revenue on page 3, the top of page 3, did this come from the statements on page 18?
Yes, correct.
Now, why didn't you use the numbers after the adjustments?
You can see if you open page 18, rent revenue, line 301000, it's base rent 2.4 million. And net operating income showed on page 21, total net income 2.06 million. It's from for 2020 income expense mailer provided to us.
You are using on your page page 3, a total of 2,886,000, yet on your page 18
correct.
it's showing 2,502,000. Did you investigate what the differences are?
I took first line, base rent. Rest, it's all adjustment. I don't look in into. And we have page line number 3, parking revenue, 416,000.
So you didn't look into the other the adjustments?
It's more accounting, but I look for base rent, the 2.47 million. What I showed on page number 3, just extract from income expenses mailer.
So in other words, you used a gross rent instead of a net rent potential, correct?
Potential, we pre-income expense mailer, we estimate potential rent after we apply vacancy.
Do you understand what page 18 says?
It's a potential rent, what I'm looking into.
I don't mean this to be rude, but do you understand the journal entries that range from 301,000 to 302,500? Do you understand them?
It's gross potential rent, what we use for estimation subject property market value. We use same gross potential rent and we apply vacancy when we have came across effective.
Are you aware that you're showing a misleading number on your page 3?
No, it's correct numbers reported to us.
Well, how did you verify it if you say it's correct?
Because it's provided to us in income expense mailer. If it's not correct information, we can request penalty for misleading.
Well, this was signed by Darren in our office. Did you try calling him and asking him what those line items were?
Our model used this information. Its Municipal Assessment Act has special penalty for not providing correct information.
Did you?
It's information, we
The
treat its
question was,
information
did you
correct.
call anybody to try to understand what those line item entries were?
I can understand first lane, it's base rent, gross potential rent, what we use in income expense, what we use in income estimation. And lumber free, it's parking rent.
I'd asked you earlier about whether or not your assessment department followed IFRS standards. Now, are you saying that you did and you didn't use these line item entries?
I just showed in comparison, I use market rent in all numbers in income producing income market model generated. That's why it's much showed. If you look on my page, where is my page? So 1 second. If you look on my page 15, model generated number showed our net operating income only 1.8 million, but agent owner showed 2.062 million. So I treat like it's fair assessment for this property.
Okay, so you're sticking by your answer that you used IFRS standard? Or
correct? It's
okay.
model generated number.
Okay, that's what I was wondering. Sorry, to your charts on pages 5, 6, I guess to 8, you put in some different properties here. We've heard about 330 St. Mary, but 240 Graham, did you note the vacancy in 240 Graham that grew from 2017 to 2020?
Vacancy original was in 2015 2.7, after 2.1, 2017 2.7. Vacancy start to increase in 2018 20.2 and decrease in 2020 80%.
The question was, did you notice that it was much higher than your model?
Correct.
Okay.
But if you look on 330 St. Mary, they reported 5.2% vacancy, and we applied 11%.
We'll get there. Same question for 444 St. Mary. It grew over time, did it not?
It was 6 in 2015, 7.5 2016, 6.7% 2017, 18. A little bit growing in 2019, 8.1%, and drop in 2020 for 5.2%. It's subject property, and we apply 11%.
When you go and look at 330 St. Mary, you're reporting in 2020 that the vacancy was 1%.
Vacancy 5.2%.
5.2. Let me just, maybe I missed that. Oh, I see, 5.2%. Where did that number come from? From the income and expense form, the statements?
Correct.
And did you try calculating that out?
It's our analysis. It's our department. I use this information.
Well, page 18 and 19, 20, and so on and so forth to page 26 are the statements and rent rolls. Did you review?
Yes, it's all this information one income expense mail provide for us, showed in column 2020. All this analysis showed average rent $15.92, media 16, range between $14 and $16. They reported 5.2% vacancy. They report a shortfall $12.43 and not recoverable expenses 1%.
On page 18, they're
On page
stating,
number 5,
on page 18, they're stating,
summary list.
on page 18, they're stating $171,000 in vacancy loss from the income stated above. That is greater than 5%, isn't it?
It's vacancy and rent-free, but we don't count for rent-free. We estimate potential rent.
Where does it say that you don't count for free rent?
We count for potential rent
Is it, you have a
from market
standard?
evidence. Yes, it's our standard for model picking rent.
Okay, well, first time I've heard that, but do you have the evidence of that statement?
Model analyze all property, similar type of property rent, and this analysis showed on page 5 through 7 through 9.
All right, well,
What model look into?
if regardless of whether that's correct or not, how about 158,000 in vacancy versus the income? Still greater than 5%, isn't it?
No answer. Our estimations showed 5.2%.
It did. Well, 158,000, even based on your error number of that's from page 18 versus your error number of 2,470,000 is 6.4%, not 5.2. Why is there a mistake?
It was estimated.
But it's wrong, right?
It's part of our analysis.
The Johnson report, page, I guess it's 9, has an average vacancy rate. Was this, what column, what category was this from? Like A, B, suburban, downtown?
Let's look at page 34. Johnson report showed downtown vacant only 10,000. 10,170 square feet, divide for rentable 147,773. It gives us 6.8% average, what showed on page 5, 6.6%, very close.
Okay, well, why I'm asking here is, I just want to clarify this. Johnson report 2020 on page 9
On page 34,
was
330 St. Mary downtown
13.7,
a 6.8% vacancy.
and I'm going to page the 2020 report for Johnson, which is page 32. They're saying Class B 14.15%. Why isn't it the same number?
Let's look page 32. We have a vacant 10,822 square feet, divide now average rentable 147,773, give us 7.3% vacancy. So
Which
we
line?
apply 8%, it's reasonable.
Which line are you reading? I'm going
On
right.
page 32, third
Right.
line,
Which line?
330 St. Mary. downtown office.
Okay, down, which class?
From the bottom,
The
on page
bottom,
42, yes.
okay.
330 St. Mary, they have rentable area 147,000 square feet and vacancy 10,000 square feet. Give us 7.3% vacancy.
Okay, so that's,
Further questions?
that's not the question I was asking you, but that does bring up another point. Johnson says 7.3, you say 5.2. Class B on
It's what reported to us.
Class B on page 32 is 14.15, and it appears you've used, I think, 13.7. I'm not sure. So which one are you using?
We use an 11% model-driven vacancy
Okay, but so you,
for
but
all similar property, OB property. For each property, we use 11%. We use 11% all my comparables. 330 St. Mary, 240 Graham Avenue, to
I
be
just-
fair, 444 St. Mary Avenue, 220 Portridge Avenue, 161 Portridge Avenue. It's similar properties, and we treat them fair, same 11% vacancy.
I was just asking the question on page 9, what the source information was for the Johnson report, where the line item was. And I still don't see it matching up. So I was just wondering where it came from.
You can see vacancy media 7.5% 2020, and we just estimate 7.3%. It's close enough.
The median, where does that come from?
Okay, no answer. Let's proceed.
Where does the 7.5% come from? What was the calculation?
Our calculation from Johnson report showed 7.3%. We apply 11%. It's fair.
Okay, but I'm just trying, where in the report? Just show me where, tell me where it is. I don't see it. I see 14.12%. Why, 15%, sorry.
Open page 32 of my brief and look specific on Johnson report. And do estimation again.
I'm looking at it.
330 St. Mary, rentable area 147,773 square feet. That reported 10,822 square feet, vacant space, 10,822 divided by 147,773. It gives us 7.3% vacancy. We apply 11%.
Okay,
It's fair.
Well, so
Any further questions?
but your page 9 is a summary of vacancy, and I'm just trying to figure out where they came from in the report.
In our model, pick up 11%. It's more as our estimation showed.
All right.
And vacancy Johnson report from June 2020 showed 7.3%. It's fair 11. Applied by model. Could we proceed to further questions?
I'm not satisfied with your answers, and I don't know how to leave this, but if you have
You
nothing,
can have opportunity to submit another
if you
evidence.
have,
Let's move off the vacancy.
yeah, that's fine. If there's nothing more that can be got down this way, that's fine. The parking income, I noted that you're showing approximately total inside and outside parking, I believe a little over $100,000. On their statement, they're showing over $400,000. Did you investigate why this occurred?
Our parking stream, let's look on my page number 10. We apply $103.50 for heated parking structure for 65 stalls. It's supported by comparable property below on page number 10, 2020 reported rental rates for parking structure. And we apply 7% of capitalization rate for structure. We have more support evidence on page 11, comparable property, actual gross parking structural rate on April 1st, 2021, comparable 26, it's subject property, showed monthly rent 178 to 300, but we apply $103.50 monthly net per unit rent per stall. We have parking lot, 23 parking stalls. We apply $92 monthly net units rent, dollar per stall, and support evident comparable property 2020 reported rental rate for surface parking, so showed media of $92, 24 cents, stabilized net operating per stall per month. Further question about parking?
Well, that's not the question I asked. I asked if you investigated the difference between your 105,000 and the 416,000 that is on the statement. Do you know?
It's reported, but we doing our market estimation.
So you didn't look into it?
It was account when model drive these numbers.
I think she said model driven a couple of times, so I think that's fine.
Okay. But I guess just as a follow-up into all this, you didn't investigate any of the statement, the actual income then, did you?
I support market-driven numbers, and our estimation, total estimation showed 27,831,000, very well supported by my evidence.
Did you determine whether or not the rents that you quoted were actual net rents?
Yes, it's actual net rents.
Well,
That's why I posted it.
For example, I'm just looking on page 24, and I noticed that the tenants all paid different operating costs. Are you sure that all these people are getting net rents, or some could be semi-gross?
What supported on page number 2, it's net rents provided to us.
It's fine, but you didn't investigate that. Is I guess fair to say that you didn't look into the difference in the operating costs then?
It's just support what market driven. It's fair. It showed potential income much higher what we estimate, plus net operating income much higher that we estimate. So our assessment over 27,000, it's 27 million, it's fair.
Okay, but on page 2, you said these are all net rents. And my question was, did you actually look at the rent rolls on pages 22, 23, and 24, 25 to determine if they were actual nets or whether or not they were semi-gross?
It was reported net rent for us.
Where did they report net rent? Where's a single statement that calls it net?
Let's look. If you're looking on page 18, we have a gross potential rent revenue, and second line we have recovering revenue. We have recover cost, operating cost, operating expenses, property tax recovery cost, property tax, rent abatement. So we have potential rent, we have recoverable rent. It's clean net rents. If it will be gross rent, it will be no recoveries at all. And gross revenue showed 2.4 million. We assess only 1.8 million. So our assessment is fair and very supported by income expense mailer provided to us.
On the pages that you're referring to, they are claiming 1,857,500 $1,857,000.
Let's open page 22 and we'll look
I'm
specific
asking
on
the
rent roll.
question. Can I finish my question first?
Let's get this question answered on page 18, Svetlana.
Okay, because on page 22 it's clean showed net rent and operating cost tax recovery charged separate. It's very clean net rent.
On page 18, it says 1,857,000 in recovery revenue. On page 20, sorry, I had it. 21, it's saying that expenses are 1,954,000. So there's a $96,000 shortfall between recoveries and costs. Do you still maintain that these are all net rents?
Yes, it's net rent.
So even with $100,000 missing?
It's net rent because if you look on page number 22, for example, first units 100, eye care service, they occupied, you can see size 2020 occupied 1,935 square feet. They base rent $17 per square foot. They pay operating cost $10.77, in tax $4.64. So if we plus 17 plus $10.77 plus $4.64, gross lease for just one unit, $32.41.
Okay, so we're still missing $100,000, right?
No answer.
Those are my questions.
Thank you. Gail, any questions?
Just in regard to the parking that is referenced, I noticed on page 10 of your information, it says there's 65 stalls. That's what it calculates for the assessment, right?
Correct, it's in our records, correct.
Yeah, that's what's in your records.
Mhm.
But then on page 11, when you have the table of comparables and number 26, 330 St. Mary Avenue is highlighted.
Mhm.
It says 43.
Mhm.
How come it says there's only 43 stalls?
In our record showed 65 stalls and parking structure. They reported 43 stalls,
Okay.
but our record still showed 65.
Okay, so then when I look at the material that you attached on page 29, 30, and 31, they seem to be excerpts they must be available online about the property.
Yes, it is information on page 29, 30, 31. It's online actual rate on April 1st, 2021. Was
Right, so it
reported for
shows
us.
there's 43 stalls in the parking.
Available for free.
Available, okay.
Yes.
43
Because a difference between 65 and 43, I'm guessing, I'm not sure. It can be leased already to tenants. It's not available 24/7.
Okay, and then the next page on the surface, it shows there's 43 stalls available there.
Correct.
And then on the following page, to me, it looks like 30 and 31 may be a repeat, showing 43 stalls and 43 stalls. Like, just, I'm wondering about the verification of how many stalls there actually are inside.
Our record showed 65 stalls and on parking structure and 23 stalls on parking lot.
Okay. And that has been historically what's recorded in your records.
Correct.
Okay. Okay, that's all my questions. Thank you.
Thank you. Bob?
No questions, thank you.
And I have no questions. So Rocky, you can start your presentation.
Okay, I there is a different number in our one that was actually presented, which no one can seem to find. And it addresses a correction that I spotted at a later date. I'm just waiting for my email to come in to tell you give you a copy of our confirmation. So it's going to get a bit messy, but if you're looking at the 12-page one, which was submitted in October, see October 19th, we have a new one that was submitted for January 30th on the right date.
For January 30th?
Yeah, today.
It's today hearing. We have 12 pages.
I can
Evidence
answer my own.
priorities.
Can I answer my own questions, please? It's dated for today's hearing, and it was submitted on time, and it's not in your package. And there is a small upward adjustment in value. And what the error was I can't even tell here. Oh, we made some small changes here. I think I can probably explain them. I just want to see something. 1374. Yes, okay. I'll explain. They're actually fairly simple to explain. So on our page 1 is our workup from the statement, and the statement we provided is the same one that the assessor has presented to you. Now the difference in that is that we managed the property. When we took the property's management over, the statements were relatively poor. And what we've been doing is reworking them and there's 4 properties involved, 175 Hargrave, 330 St. Mary, and 2 parking lots. All the parking income has historically been placed into 330 St. Mary because the bulk of the parking comes from this building. So it was always, it had been collected from the tenants of this building, but the revenue applied to other roles. And that's historically how it's been written up. So now it's been changed over time and removed, but the rent is still listed in here for all the buildings. So if you, on page 3, 416,000, this is the parking income for 160 Donald, 325 York, 175 Hargrave, a couple of stalls outside, as well as the inside and outside stalls at 330 St. Mary. What we've done is remove that from the overall income and then place the number back in later. The rest of the statements, this building is owned by a company that's traded on the stock exchange. Therefore, these statements are IFRS compliant. So when they show these revenue adjustments, they reflect actual income going to the real estate of the property. So the 2470 becomes 2502 with 400,000 in parking income. So it's actually 2.1 million plus parking as full. Then what the calculation would then be is to adjust this for vacancies, and so this was done, and the calculations, again, the statements are all the same. There's nothing in here that doesn't belong. I've pointed out to you that there's a shortfall of over $100,000 from the operating expense and the recoveries, and that's because not all the rents are net rents. In the statement, which is the rent roll, which is in the version we submitted for today's hearing, we did have that rent roll, but fortunately the assessor has provided it. So I am going to refer to the assessor's evidence just to show you that there are some gross rents in this building. On the assessor's information pages 22 forward, there, if you'll note that the the recoveries are differing through the statement, where I'm just changing my view here. That you'll note that some of the recoveries are at, if you look at the top number, and this is a historical recovery, is 1077 at the high end. And as you glance down, you see numbers as low as 1008, and there is one at 759, and I saw another one here in this 3 digits, 954, and that was the unit 900 and 1000. So the recoveries differ, tenant to tenant, and that's why there's that shortfall between recoveries and costs, and that's how we get the net on our calculation to 1,702,000, not counting the parking. Our calculation of vacancy is 11.45, and the building has over time has had not the relationship that the assessor has shown. It's we've managed the building for quite a few years, and at one point in, I believe it was 2019, they hit a vacancy of 3 whole floors. So that's you're gonna ask me how many floors we have here, and I don't know. We have 11 floors, so we had a 30% vacancy at that point, and then it was backfilled. Today our calculation is based on a review of the statements. The 20 statement is about I didn't do it here. I'd have to calculate it on the numbers. It's going to be, well, it's there in black and white. And we also had income during this period from, there was some COVID relief income. I don't even know if we've ever got into this concept of is this income or not. We had, so I don't even know if we're speaking to that. But when we reworked the statement, that was the number. And then what we had to do is, if you go down the statement, okay, the vacancy, what we ended up applying was, looking at the city of Winnipeg in the Johnson report, the overall average was 9.9%. Downtown B was 13%. So we used 11.45, which is the mean, and this is just to ensure a greater sample size. And that's 11.45, fairly close to what the assessor has done. Oh, that's a mistake. Huh, the shortfall's wrong. It's completely understated. All right, well, the shortfall is understated, but we're not going to change it to go higher. But under the shortfall, we've added back in the income, and we do know from our operating statements that the number is fairly close to what the assessor has, and I think that's why we use the assessor's number. What we have is stalls in the basement, and they're actually 63, and then the outside stalls, I've forgotten how much they are. I counted them once, 24, 25. So we don't take a major issue with that income, and we added it back in. So after the vacancy costs, we bring our NOI to 1,374,000. The change we made in our properly timed version was to change the cap to 7. And that comes to a number of 19,636,000. That's actual income capped at 7%. And our realization of, our concept on the cap rates was, again, looking at the best rate of 6%, but which, by the way, has never been applied in Winnipeg on an office, because it's a rate that represents an optimal rate. Winnipeg doesn't have an optimal performing downtown office. The property rights, being on the skywalk is a costly venture, and we're bound to pay for it, for the maintenance of it, as it goes through our building, regardless of what our income is. An investor would has no protection from that, and so it's a downward impact. The age, it's not new. It is suffering from some age and difference. And you'll notice that we break down year built, quality, and condition, 3 categories rather than an effective year. Where's I can tell you why we were a little more critical of the quality and condition in this building as opposed to other buildings. We have some deficiencies. For one, our plumbing stack. And we ran into this when Colliers, I'm sitting in the building right now. When Colliers came into this office, we should have had to modernize our restrooms to do the barrier-free standard with a 5-foot circle. But our plumbing stacks couldn't deal with the issue. So we're restricted by where their location, their size, and the way they core through the floor. We couldn't do that. Our visibility, our thermal break is poor. We have suffered since it was built. Today it's in the afternoon, so I'm on the west side. So we are now, and our temperature on the west side is, apologize, I'm still in Fahrenheit, is about 77. And on the east side, out of the sun, it's about 65. We can't get the temperatures right because the system, the mechanicals can't handle it. The basement parkade was not designed properly. There's some rebuttal information in terms of our obsolescence, and I don't know if it's new evidence or if it's rebuttal to the assessor's concept of quality, and you can put whatever weight you want it that you'd like. But there's pictures, all the cars who park in the basement have dented right front fenders because of a design problem. There's a 90-degree turn with no clearance for entry into a 7-foot lane. So imagine doing a 90-degree turn and ending up in a 7-foot lane over a distance of 20 feet, which is the length of the car. And that's a problem that can't be fixed because it's structural in nature. So that was our issue with it. The turnover, and then there's the turnover, which is typical of all buildings in the area. This morning, I just looked to see who's on the next up for renewals, and we've got 2 floors coming up that haven't been confirmed. So it's just an ongoing problem. One of my clients jokingly said to me, "Why does anyone want to buy an office in Winnipeg? I could never handle the vacancy and the turnover." It's not like old style suburban where you can be there for 20, 30 years. It's 5 and 10 years and then turnovers. So they're not the greatest money makers. And I think the 7% is fair. Incidentally, when it's sold as a multi-role, it was forecasted, I believe, at 7.7%. That was the target at the time. The only upsides that have occurred are in the parking, which doesn't affect this building. The outside parking, that was part of the multi-role, because when the Jets came back, their income came up. But our building does not allow casual parking on any of their parcels, so there's no upside on the income. Overall, we capped everything at 7%, all parking income and all property rental income, because it's one role, one title, and that's the proper way to do it. So the calculation, the summary of the calculation is at the bottom of page 1 as well. What we do in buildings like this is, and this, if there's questions about the statement, we considered this building from the outset to have to be done in the gross style rather than the net style, because I showed you there's differential recoveries and there are shortfalls. So you add up all the income, recovery and income, and then you subtract all the expenses, and that's how you get the income that's stated there. So that's a calculation of the value, and there is some rebuttal information. I think that's my presentation. Thanks.
Thank you, Svetlana. Any questions of the presentation?
Yes. How did you estimate parking income? It's very
I say,
confusing. Last line, you have
I-
revenue less parking 3.8 million. After you use expense less 2.1 million. And now you have net income 1.7 million.
Right.
How you did it?
it's from the statements. You'll note that the statements have all the information and data here. We took out the 415,000, 16,000, because that's revenue for all 4 lots. And then we put back in the net revenue of 106,000 or just the ones on the property on the subject tax roll. And I think that's the same number you're using.
So you don't have any evidence support your statement?
I have a statement. Colliers manages the building. I park in the parkade. I don't know what more you could want.
So you don't have estimation how you did it, so we cannot verify it? It's
Well,
just,
we're using the same number as the assessment department, so I'm wondering what your complaint is.
okay, you haven't provided any market rent for this subject property?
They are included in the copy that the board does not have.
So
or
it's not supported, it's we don't have, it will be new evidence for us? You're comparable on page number 7.
You're
of your
interrupting
bill.
me again. For the purpose of what the board had determined was going to be the evidence, it was not presented. It has been filed. I just received an email from the person who filed it, who is looking for his receipt, and he just sent it to me. I have the workups here that was sent in, and he sent them in January 17th, 2023, which is the same date you sent in yours.
Yeah, and you have evidence 12 pages only. Your comparable on page number 7 doesn't represent downtown Office B market, correct?
I'm just going to forward these to the board with my receipt of sent.
Well, again, Rocky, that's less than 14 days before this hearing.
It's the same date the assessor submitted hers.
And we have your evidence 12 pages.
The same date as the ones I asked for in the beginning.
Mr. Chair,
Yes?
we have received the assessor's evidence on December 23rd. So actually the actual date of receiving, the due date for evidence for this hearing was December 28th.
December 28th.
Yeah, because it was scheduled on January 11th. That's where it adjourned from.
So then it wasn't submitted in time for this hearing, was it?
No, it was like, yeah, I have some emails from Mr. Newfield. It's for January 17th. But the actual date of exchange for the evidence was December 28th.
December 28th, which is for this hearing. Right, because the January 11th hearing was the one that we're hearing today.
Yeah, that was the hearing that got some issues of the applicant.
Our response from the and I've sent this in from the board was that the evidence will be marked as a late submission and be at the discretion of the panel at the scheduled hearing. So it was submitted, you're marking it late. And if we go down that path, I'll send you 100 ones that I've received late from the assessor. And, whatever's fair is fair.
Okay, we'll take a 5-minute recess. We probably need a recess right now.
Yeah,
Yes, Mr. Chair.
thanks.
PLI, Mr. Chair.
Thank you very much. We'll reconvene the hearing. And Rocky, you can speak to that evidence verbally.
Yeah, great. And that's really all I wanted to do. I want to speed things up just as badly as you do. Okay. Where was I? Oh, assessor's asking me a question.
Svetlana, you're muted.
So let's look on page number 1 of your estimation. Your net income of gross income, you estimate 1.7 million, correct?
Yes.
You don't provide any market evidence for your estimation. You use only income expense mailer that reported, correct?
We relied on the actual income the building produces.
Okay, let's open page 3 of your breach on your evidence on actually recorded gross rent 2.4 million, correct?
No.
Yes, no?
I said no.
And your vacancy, you estimate it's actual 195,000, correct?
No, that's not correct.
If you look, it's on your page number 1.
You said, did I use actual? I said no.
But you use actual income expense mailer, and they reported less vacancy rent only 171,000, correct?
What I used was not the mailer. I used the statements. Statements were provided by our company for the owners and their shareholders, which the city was got a copy of. They weren't made for you. They're made for the investor. And 1 year does not represent an entire building's experience. The prior years, which I'm speaking now too verbally, were less than that. Because we had the massive vacancy of that when there was 3 floors. Collier's, we moved in 21, was one of those floors that backfilled that vacancy. So that's how the office works. Bad years, good years. I've heard it already in 200 Portage. And we felt that the proper way to do this was to stabilize. And we think that the market-based way we did it in this case was the best approach.
And you want, what about structural reverse 2%? What it is about?
What page are you on?
I still on page number 1 for income estimation, market value of subject property by agent.
The concept of non-recoverable costs in appraisal theory is generally broken down into recurring non-recoverable costs, and they're all generally detailed with, and you can see the statement is full of them. And then a structural reserve, which is in place regardless of when a capital cost is incurred or not, is always allocated in any appraisal, any valuation, because everybody knows something's going to break. And usually it's the roof or the chiller or the elevators. And you don't always get to recover those. So every building has a structural allowance. Generally 2% of income is the target, and that's worked out pretty well in the market. So all properties would put that in as a reserve. So when a capital expense comes along, and the most common thing is generally a roof replacement. A roof's got a 20-year life, and you figure out how much it's going to cost in 20 years, and it's pretty close to being 2% of the income per year. Money for these repairs is not invented or created or pops out of the air. It comes out of the earnings. So this is a stabilization of those capital costs. Now, some people go and say 7%, we'll do it across the board and lump them all together. Okay, it's semantic. I don't care for that. I like to be detailed on what people should see and consistent with appraisal methodology in a global way. And that's a good way to separate these numbers is 5% and 2%. And in the past, until 4 years ago, the assessment department did it the same way at 5% and 2%. They labeled them differently. They always called the 5% management and 2% other. But under review or whenever we went to a hearing, everybody agreed management equals non-recoverables, 2% equals structural. So there's always been an agreement on that subject until I guess it was the reassessment from 4 years ago where the city believed that they didn't exist anymore.
Are you done? You would agree that structural repair or capital repair, it's expenses for landlord to provide accommodation for tenants. It's not part income estimation.
No, that's absolutely incorrect statement. It's always part of it. It's just the way that it's calculated. It's amortized rather than put up as an expense, because no one in any given year is going to come up with $300,000-$400,000 to repair a roof. But you do have to keep an allowance for it because it's money. It's really simple. It's just all the money.
It's what owner should landlord should
if the
invest
owner,
to provide tenants with suitable space, correct? It's a capital cost. It's not part income estimation.
He doesn't agree with you.
Okay, how you came up?
The world doesn't agree with you.
But it's
The world isn't at the hearing.
not recoverable expenses. How you came across 75,000? Where is your estimation?
Non-recoverables. That's 5% of the income after vacancy.
What about shortfall? $7.96.
That
How
was
you estimate this? You didn't provide any estimation to verify.
Well, I'm looking at it here on page 1. Our calculation was taxes at $4.51, utilities as vacant at $2.45, and repair and maintenance at $1. And that's when I remarked that's a bit on the low side, because you got to pay for the skywalk if you're empty too. So I think the true shortfall is a fair bit higher than that. You know, I think the assessment department's number at I'm just looking for it here. Their number is $12 a foot. It's probably closer to the mark. It just costs more money to maintain a building that needs a better image.
According to income expense, Meller parking income was 416,000 round. You have parking income 106,000. How you estimate this?
Well, if you note your own evidence, I will show you what happened here. And again, I can refer to this because we do have it in somewhere, but it hasn't been submitted. Now, in your evidence, you'll note that in your rent roll, around page 22, 23, there are all sorts of entries for parking. And wherever there's an entry for it, it's been zeroed out. So our problem with this building on management is that they have now zeroed it out, and Indigo does a statement for all 5 of the parking areas for combined income, and it's placed in the statement for 330 St. Mary. And the reason is rather interesting if you knew anything about IFRS, in that it's put in there because as a ground rent, there's rules about how it's to be declared, and parking is always deemed to be a ground rent. But in this case, it's emanating from the tenants rather than from just all casual. It's part of that economic package. So for years, it's all been put into 330 St. Mary and or allocated to 330 St. Mary, and they could put it in 175 Hargrave if they like. But our statements have always been run this way, and it's the way the accountants do it. So we've been going over this for some time, and we take the report from Indigo, which is submitted to the city. So you will see that the same number is on your income and expense forms. If you reviewed your parking notes for 160 Donald and 325 York, you'll see that income is there. And what we've done is allocated it because it's one economic unit. It's the way they do business. They're not obligated to make their statements fit the assessment department's model. They're obligated to run their business the way they see fit. This is the way they do it. So we just have clarifications to do at hearings. It's a fairly simple process for us.
So they reported net income for parking 416,000. Your parking income 106,000. It's 74.5% less what reported, correct?
It is, as I said, at the risk of repeating myself, all part of a multi-role operation.
Okay. Your site-specific net operating income 1.3 million, correct? And subject property income expense Miller short net operating income 2 million. How you can explain it?
I think I just went through the process. We took out the parking income, and the adjustment was based on that. And then the actual vacancy rate was calculated at a slightly higher to account for previous years. And not all of the short, yeah, those are the two major factors. Not the same. They're not all nets. No, wait, that's not part of it. It was a higher vacancy, historical, and the removal of parking income.
So your Colliers publication from Q1 2021 showed downtown B property maximum 6.75% capitalization rate, and you asking 7.25%, correct?
If you recall the information that I presented earlier, those cap rates were produced as a marketing tool, and they don't represent valuation. And I think it's very clear that we have a different outlook on the way things are calculated. The biggest difference being is that our brokers who provide these rates tend to look at a purchaser's cap rate, which includes all sorts of costs, like land transfer fees and commissions and expenses after purchase, that aren't part of a deal and aren't part of the way an appraiser or an assessor would do it. So they are written for a different purpose. They're not designed for the assessment department's use. And because I work here and I know how they're created, I'm able to show you how they have to be adapted for it. Because again, it's just math.
So your estimation site specific and still your number much lower what's reported for 2020, correct?
No, that our value is based on the actual performance of the property over a long period of time.
Okay, no further questions.
Thank you. Gail, any questions?
Just in regards to the parking, Rocky, the distribution of this revenue. You said $106,122 attributable to 330 St. Mary's. So where did the rest go?
The rest goes to, if you look at our picture on Page 1.
Yeah,
Okay. Oh, that's not a good picture. Maybe the assessor's got a better one here.
I guess my question is, have you advised the city of the desire to assign parking to different properties, or is this the first?
This has been going on for 5 or 6 years, and the viewpoint of the owner is that their own reporting takes precedence over whatever the city needs, and the city can go to the trouble of calculating it themselves. That's not an arrogant approach. That's just a practical approach. Every one of the mailers that the city sends out, you read a standard mailer, it doesn't fit our statement. So if we change stuff for the city from our statement, and then we then become liable for it. We're not changing our statements for anybody. I'm looking at camera here. This building is owned by a publicly traded corporation. They do not have different values for different people. They get what the shareholders get. And if the city is, and they're marked all the time, they go, well, this is for these 4 rules. And the ones that they're on are the assessor, I guess, has a better picture on her page 3. You'll see that the subject is outlined in purple. And so the outside parking on the subject is on the east and the south side. And then there's underground parking. The building immediately south of it is 175 Hargrave, also on the same economic unit. And then the parking lot south of that is 325 York. And then the one at the corner of York and Donald is 160 Donald. So all of those, and Hargrave has its own 5 or 6 stalls. So we have 5 different parking areas. I'm looking at a statement right now from Indigo on the rent revenues, and this is for a prior period, and it was $300,947 for a prior period for all of the sites. So it's what we send in with that, and the challenges have always been to try to deal with the IFRS standards that they trade by, and the local standard, which is kind of behind the times. I'm not trying to be evasive at all. It's just that this is we're giving the city the same information the shareholder gets.
Okay, so I understand then that the shareholders for these various properties, you're reporting to them and providing where the parking revenues to be assigned. For the purpose of city's assessment role, they're looking at the real property rule, which has a title that includes 330 St. Mary's Avenue, and it includes this land, it includes this underground parking, and the assessment is being applied there.
Well, yeah, I don't know if the assessment's being applied because they always do it from a model, but they present this as evidence of the role, which is the full or whole or parts of 4 different roles, so we have dealt with this numerous times on the penalty issue as well, because the assessor says you're not giving us what we asked for, and our answer is always the same. You're asking us for a different set of books. You know what that's called when you're running 2 sets of books. The information is always publicly listed in their securities exchange filings as well. So we're not, leaving anything out there.
Right. Okay. So I think I have it clear in my mind then. Thank you very much. And thanks for your presentation.
But it's also in that book, that big long book I told everyone to read on IFRS about ground rents.
Yeah. One more question in regards to the cap rate. You're proposing 7%. And so in your estimation then in your request. One of the matters that I heard you say is about the skywalk being attached to the skywalk is a risk.
Well, not
Is it not?
the cost of maintaining it, which
Okay.
we're all, everyone has to pay for their share of it, and it's utilities and upkeep. The city does some work on it as well, but it enters our building from the north and turns the corner there and heads over to the convention center. And what we have to do as a result of it is not just cover off utilities and some maintenance, but we run on a security guard because we've got this thing going through it. So when you look at our expense side, you'll note that how much is that those guys making? It's in there. So I think that people are going to look at that as a risk, not a risk, but a cost that is $88,000 a year. Oh, 96,000 a year for that. You're prone to, there's more vandalism due to it. You'll notice that we have a vandalism entry here. Where was it? I was looking at it on my page 4, vandalism repairs. It's a good thing to have for attracting rent, but then it means that you got it's like having a car that has more options, and the options will break down more than a basic car. So your investor's gonna be a little more critical of it, I think.
Okay. Thank you very much. Those are all my questions.
Bob, any questions?
I have no questions, thank you.
And I have no questions. Jazz, did we get the rebuttal?
Yes, Mr. Chair, it's in the folder. It's labeled as a 22-18-52 applicant rebuttal obsolete something.
Yeah, it's the third document down. Everybody got it?
Yep.
I sent you an email, Michelle. You have it, Svetlana?
We're talking about consolidated financial statement.
No, it's pictures.
Yeah,
There are 2 documents in there. The one you just said, and there's another one, applicant rebuttal obsolescence something.
Picture,
Yeah.
I see it.
So you've got it?
Yeah, I see parking structure, cars. What about?
Okay, Rocky, you can proceed.
2 documents. One was referred to, and this is a specific one to the owner of this property. This comes from their financial report. It's marked IFRS -IG, and it's just a recap of everything I've said about. And again, it comes under rebuttal. I asked the assessor, you know anything, or do you follow it? And it is some difference. And the key item that is stated here is it doesn't have to change your value. It does have to change your reporting methodology. It talks about all the what you can and can't count, the capital assets over their lives, and when it moves from capital to being a cost. Page 85 forward, 85. Well, it's not that long, but it's just their report and their statement that I included here. Just again, it was just the backup of that. And I don't know if there's any questions arising out of it, but Okay, the other one is just some pictures. I was brought up the question of to the assessor about the building and the way that tenant improvements were dealt with. This is just kind of an idea of what goes through a typical space turnover. This is my space, and yeah, you can see where my office is right now behind that ladder on the first picture. When Colliers took the space over, like most spaces, everything was removed and they restarted and did layout here. This is got a lifespan of the lease, because once, if we leave, next guy along comes the same thing. So it's going to be a recurring expense. Buildings are meant for this. They use the steel studding and partition walls, and what you get in the end is the picture on the second page at the bottom, what we look like today. Now, the built-in obsolescence on this, why these things don't last, when our designer planned this out, she did so on the basis of this modular furniture. It has 5 feet separation between people, and our occupancy date was supposed to be early 21. Plans were done in late 19. We all know what happened with 6 feet. So this is just an idea of about why is it capped that low, because things are always changing. The next person along will not be able to reuse this, and you start all over and you spend all over. I also brought up the poor design, the cap rate issue. The bottom picture is this design of the basement, which is the 90-degree turn into a 7-foot hole. And that wall where that piece of styrofoam is on is target practice for all the cars that are in our parking. One day I went along, maybe I hit the wall. We'll just say one of those pictures could be mine. And I went and took pictures of every car in our parkade, right front damage on every single one of them. So it's an afterthought to a design, the correction to it is on that exit is to try to take out the bearing post and put a header across to get some a double door in. That would probably be the best fix to it. But the other thing was, there was some debate, how many stalls do you have? Now, in my bottom picture, you see that black car? I got them removed. Me. Maybe it happened after I whacked the wall. You can't park that close. They're going to lose 3 stalls for this because it's a poor design. So that I'm crossing the line into direct evidence, but we had attempted to submit this. That's all I had. I was going to point out.
Svetlana, any questions?
Yes, I have questions. How relevant independent auditor report to the shareholders of EGM Financial Inc. for 2012, December 2012, when we have a reference date 2021, April 1st, how it's relevant, market 2012 to 21?
Well, if you note, if you read the report, you would note that this is when they enacted the IFRS standard. And this was when they had to start reporting to their shareholders about the significant changes in accounting practice. After they reported it, they didn't have to keep doing it. I thought it was pertinent because it would help the board and the assessor understand that everyone's using antiquated valuation models, and we all have to start talking about a more standardized thing. Whatever system the city uses or what small businesses use in GAAP is going to move to the IFRS standard, or it could change again. It helps one understand the statements. A previous statement, for example, if you ran a statement under the old way, you, instead of showing the income that they shown, they would have just wrote in the net potential income and handed it to you, and they would say, as we had said, approximately $1.8 million with income and parking. And then, without explanation. What the document speaks to is the need to be transparent, clear, and having no chance of being misleading.
I think that answers.
Would you agree that this document, it's part of new evidence presented during hearing and we should ignore it?
No, because I asked you the question if you understood it, and you said you did, and you applied it, and I think.
I didn't apply anything, I just open and I see
And
what
it's-
is it
As I
and try to
mentioned
figure
before,
out what is it.
well,
It's post-reference information and should be
Svetlana,
removed from evidence. It's
we
my
will-
statement, thank you.
we will consider the evidence as submitted or not. All right?
But in my opinion, it's new information presented during hearing. I have my opinion too. It's up to board decide how he uses
Exactly.
information. Thank you.
Gail, any questions?
No, I have no questions, thank you.
And Bob, any questions?
No questions, thank you.
And I have no questions. So we got through 2 properties in 4 hours. We're going to take a 10-minute break and come back at 5:20.
Yes, Mr. Chair. We lie, Mr. Chair.
Thank you very much. We'll reconvene the hearing this afternoon. The next property in the docket is 171 Donald Street. Any preliminary issues with this one? Either party?
I'm waiting.
What's
I don't,
that?
I have none. I'm just waiting.
Svetlana, you're muted.
No issues.
No issues? Okay, you can start with your presentation, 171 Donald.
File number 22-2306, roll number 120-9334820. We are valuing the property as a stand of January 1st, 2023, based on the economic condition April 1st, 2021. This appeal is with respect to the amount of the assessed value only. Based on the evidence in this report, in this assessor opinion, that the market value of subject property as of April 1st, 2021 is $2,728,000, and that the 2023 assessed value should be confirmed. The subject property is office building built original 1964, a half land area of size 12,000 square feet, and gross floor area over 22,000 square feet. On page number 2, started air photo of subject property, rectangle shape of land, street view on page number 3. The subject property, it's office building. I have presented 59 comparables of similar properties. It's on Edmonton, Broadway, Portridge. On page number 5, like look and summary of my comparables. Average rent for 353,239 square feet. It will be $12.62. Average weight $13.08. Media $12, and this range from $7 to $19. For subject property, we apply $12.38 for 17,850 square feet. We apply a vacancy loss 12%. It's OC property. Expenses 3%. Shortfall $10 per square foot. E-capitalization rate 6.8%. That give estimation of office $2,458,000. On page number 7, I have presented income for parking lot. We have 11 stalls. We did apply $92 per net per units per stall, and our capitalization rate for our parking lot 4.5%. So estimate value for parking $217,000. Below comparable property 2020 report rental rate for surface parking, we can see that media of this parking $92.24. It's stabilizing, not operating income per stall per month. So on page number 8, summary of two estimated income. So our estimated market value $2,728,000. Market value of subject property as April 1st, 2021, and that the 2023 assessed value should be confirmed. Thank you. Any questions?
Thank you, Rocky. Any questions?
Yes. Page 6, was this done by the model?
Yes, it's model-driven numbers.
As well as page 7 for the parking?
Correct.
And you have a few pages of rents, I guess, page 4 and 5. Did you prepare these?
It's all available rent for this type of property in our portfolio.
Did you prepare it?
It's our study. It's rent from 2020 to 2018. Recently rent for similar type of properties.
Okay, but again, I was just asking, did you prepare it? Yes or no?
It's our department valuation analysis, what I posted in my brief.
Okay. Sorry, I'm just wanted to make sure I had the right copy because I think I might have two different reports here. Remember the two came in? Yeah, I do. I want to make sure I got the right one that you're relying on. Perhaps if you go to page 4, what would be your first comparable on page 4?
254 Edmonton.
Oh, okay, 254 Edmonton. Okay. All right, so I got the right one now. I'm just changing to this one now. These rents, you've got a number of them that are in the suburban areas, such as 1790 Wellington. Are you relying on those?
I rely on all comparables, 59 comparables. It showed average rent $13.08 for 353,239 rentable area.
So you're relying on I guess Wellington appears to be the only one that's not in the downtown area. Oh, I see also a 1200 Portage and 825 Sherbrooke. There's a couple others here. So you're relying on 1790, 1780 Wellington?
I relied on average weight, showed $13.08, and the model applied $12.38. It's fair and very well supported by my comparables.
Where is 1780 Wellington located?
It's suburban, but it's OFC rent for
Near
our portfolio.
Near the airport, correct?
Correct.
And what is the classification of that building?
If you remove comparable 4 to 7, it still will be $13 per square foot, and we apply less as $13. It's fair.
Well, okay, that was going to be my next question. But going back to the class, I'm looking at the Johnson report. They call that a Class A space, suburban. Are you aware of that?
In our portfolio, it's OFC, similar to the subject properties.
And do you know what the classification of 171 Donald is?
It's not relevant for rent space comparable.
Do you know what it is?
No answer.
Do you not know is the answer, or yes or no? Do you know the answer?
It's not relevant. It's my answer, no.
Well, you're being non-responsive. I'm just asking for a yes or no.
Rocky, hold it here. She answered that the valuation was a result of the model.
Right.
Period.
Well, I'm getting somewhere with this very slowly. If you removed all the Wellington ones, which appear to be at the high end of the range, did you have a number that it changed the average to?
You can see that Wellington showed $18.25. We apply less than $13 per square foot. It's fair.
You said earlier when I first asked the question that you're relying on the average. Now we're talking about whether
average support market driven, model driven $12.38.
Right, now if we take out the ones, the class A near the airport, would the average go down or up?
It will be very close.
Wouldn't, okay, well, I guess I'll have to calculate it myself.
Be my guest.
And in
Well, we're not going
regard.
to stop this hearing for calculations where 59 comparables are involved, period.
Okay, just a couple I'm looking at here. Unit 108, 305 Broadway, is that the dentist or is that the Starbucks?
It's OFC property.
Well, there's only two tenants on that. Oh, sorry, I got that wrong. Is it the Fix Coffee Shop? Do you know?
What comparable you talking about?
Number 10?
10 units or 8 on main floor.
You don't know what it is?
No, I don't.
Comparable 17.
And they rent for $15. We assess less as $13. It's fair.
Comparable 17, is that still in the building? Or did they vacate with the rest?
17, it's a main floor. 27 for 20 Airport Ridge, it's main floor. It's a rent for 3 years as 2019. They still there, rent for $14 per square foot.
Oh, okay, I was, make sure I'm looking at this right. I was asking about 305 Broadway, unit 200, number 17. I'm just looking at
17.
I'm looking at the rent.
It's a second floor, size 2019 for 5 years. It's still
Okay, now you have a couple in here for 414 Graham, number 18, 19, and 58. Who's the tenant?
It's a office space, at 18, it's on main floor, rent for 10 years size 2019 at $18. Another rent size 2019 for $10 for 14
Yeah,
cents
okay,
per
but I
square
asked
foot.
you, who's the tenant?
It's a office space.
Do you know who the tenant is?
Do you honestly think she's going to know every tenant on the list?
Well, but that's why I'm asking. There are three
Thank
from the
you.
same building, which I know to be owner occupied. And so I think that's a fair question. If you're using owner occupied
Do you
rents.
have any evidence support your statement?
Well,
Present it
no,
to
that's
us.
why I asked if you tell me if you know who the tenant is.
In our record supported by income expense mailer by the owner showed that comparable number 19 was rent size 2019 for 10 years, around 6,000 square feet at $14 per square foot. We assess less as $13 per square foot. It's fair.
Is the tenant 24/7 in touch?
No answer.
There's nobody else in the building but 24/7. Do you know that?
No
Are you
answer.
aware? Are you aware that it's
I
completely
don't know.
occupied?
She
I
doesn't.
cannot know everything.
Okay. I'm just gonna touch on a couple more, and I'll move on. No, actually, that's fine. I was just looking at those ones that stood out. You're showing there's a couple of units in the building that are rented by tenants, as you remarked on your page. Oh, sorry, that was the older version I was looking at. Okay, well, on your rent roll, page 16, there's 2 units that are rented at $22 gross, and they're on the 4th floor. Did you try to calculate their net rent?
Page 16 of my brief. It's gross rent. I cannot assume how much net rent. It will be a lot of assumption. It's not relevant.
Okay, so the answer is you did not calculate the net rent then?
No, I don't know how,
Okay.
because it's gross rent. We rely of clean net rent, and I showed you 59 comparables. Clean net rent is similar property, like subject property, same classification.
Which premise IDs are they?
I don't know answer.
Okay, 1,200 and 698. So they're number 12334 and 26280, which you put in at 14, or the models put in at $14 and 14.53
Yeah, for
And-
smaller space,
and
it's
they're
economic
rented-
of scale.
at 22 gross then, correct?
I don't know about gross, it's net rent, what
Okay.
posted by.
Sorry, just the capitalization rate, and you're saying there was no overrides on this? This came from the model
Correct.
for how did the year built change from 1964 to 1976 as an effective year?
I don't know.
Are there?
I don't
any-
have any support evidence for this answer.
Okay, if it
I
were-
know that the city of Winnipeg charged 6.75%, and we apply for this subject property, model generated 6.8%. It's inside this range.
If it were the actual date utilized for the age, would the cap rate go higher?
I don't know.
The parking is capped at 4.5 versus 6.8 in the building. Are they on the same title?
If you look on my comparables numbers on page number 7, median $92.24 and average $92.78.
I was asking about the
Stabilized
cap rate.
net operating income bis months.
Are they on,
Capitalization rate 4.5% for parking lot across any portfolio for 2023 assessment for parking lots.
well, you have a picture of it on page 3 that shows the lot lines. Is there one title on this or two titles?
This titles has 11 parking lots outside building.
Is the lot capable of being sold independently?
No, it's part of lots, part of properties in our portfolio.
And when you counted the stall count, how did you factor in the tandem parking?
It's parking, 11 parking stalls. It's in our records. If we came across something different, we will be changed this number. I rely on our records. For me, it's correct and it's up to date.
On your page 7, you indicate $12,000 net income for the parking lot. On the statement they provided to you, they've got revenue of $2,000 a year.
Rocky, can you speak up?
Oh, I'm sorry, I'm blocking my speaker.
No.
The statement, page 13, shows that their parking revenue is $2,467. On your statement, on your workup, you're indicating $12,144. Did you attempt to reconcile why it was 5 times higher than actual?
It's supported by market evidence for surface parking similar to the subject property, and they showed a media of $92.24 per stall per net operating income per stall per month, and we apply $92 net operating income for 11 parking stall.
Okay, but the question was, did you attempt to reconcile it? Yes or no?
No,
Okay.
it's model driven.
Have you ever been in the building?
No.
Those are my questions.
Thank you. Gail, any questions?
I have no questions. Thank you for your presentation.
And Bob?
No questions, thank you.
And I have no questions, so Rocky, you can proceed.
Okay, which one, you have the 21 page document, I take it?
That's what I have.
Okay, so we did provide more. The building is predominantly owner occupied and has been the head office for Crosstown Credit Union since the mid-60s. And yeah, I was in there in the mid-60s. I remember going with my dad. That's where he banked. But I've worked for this client for 20 years, and it's just an old miscellaneous class building. There's nothing special, nothing fancy about it. It's got tandem parking. And over the years, it's devolved as a banking institution and gone more to administrative uses. They've always had other tenants in the building, and from them, we've managed to use rents and extrapolate for the balance of the building. One of the discrepancies is always been the basement, and so I just want to check something here. So assessors 17,851, and we're 17,810. Okay, not a major difference. We have the two rents listed as gross, and then you can see what the expense calculation is that comes from the statement. So those particular spaces would average out at about $10 a foot, $7 to $10 a foot. That's the actual calculation. Those are the ones the assessor has $14 on, and the actuals are 10 and 7. So what we've done is applied 10 to the owner's space, which includes basement and first floor. So the first floor would be more and the basement would be less. And we've done it on the bulk basis because they are occupying the basement, the first, the second, and the third. And then the fourth is this tenant. So the blended rate is $987, which includes a basement. And we did have other rents that are in the other report, but this is very well supported by the performance over the last 20 years. For vacancy, this is rather interesting because Johnson calls this a Class D building. And I had asked the question earlier about classes. This is pretty much the lowest class. But oddly enough, Class D also infers a lower vacancy rate because it's a different sort of concept. It's I'd rather be full and not getting rents than have any sort of vacancy. And that's the way people with Class D think of things. And rate of return, just make sure I'm turning a profit, making money. And that's why it's lower. So we again looked at the office rate, average 9.9, then dealing with the smaller sample sizes, average that with the Class D at 4.8, and we get 7.35. Like I said, the concept is simple when we follow the market. These buildings do, and I know the assessors at 12%, but these buildings generally will have a lower vacancy because the rents are set that way. But however, if you wanted to try to get $14 rents, then maybe you will have a higher vacancy. The non-recoverables, this is a gross building, and the statement is very clear that they have a high degree of them, and as with all office buildings, all investment buildings, non-recoverables are a required portion. You have to account for them. They don't happen every year. They happen as you turn over generally, and to not do so would be misleading. And that goes in line with the structural reserve. So our shortfall is calculated on the actual at 713, and I know it's lower than what the assessor has, which means we're indicating a higher value, but it's based on the largest component is our taxes in any sort of a shortfall, and the taxes are lower because it's a Class D. And the utilities are and the repair and maintenance go with that. So our calculation is 142,136 for NOI, capped it at 7.5. And normally you would be a little bit more aggressive with a building like this, considering its age and the fact that it might not be performing at its highest and best use. It's been there since 1964. It's tired, it's old. One of the considerations is to consider is like maybe you bulldoze it. And if you're not performing at a high enough rate, then you would consider the land value. 17,000 feet is roughly 4/10 of an acre. And our test is what would the land sell for? And I still think it's performing at the amount we have calculated above the land value. But as it creeps closer and the income drops, then the concept for alternate use is bulldoze and redevelopment. Now, what you do have to bear in mind when we talk about this, it's not an incremental value. It's an either or situation. It either earns money as a building, or it gets bulldozed and it gets its value out of the vacant land. So that's why I think that the cap at 7.5 is a bit more aggressive than normally you'd see. Essentially, buildings like this should cap higher, but it does have a good location. The building next to it's being repurposed, were bulldozed and it's being redeveloped. It's got the location near the arena is good. It's not good location for earning rental revenue. It's a good location for redevelopment. But at 1.9 million, as we have pegged on it, that means you're going to have to hit a land value of 4.8 million an acre, and we're not there yet in downtown. That's $109 a foot. Last sales we reviewed, those for parking lots, it was at the board, $85 a foot seemed to be what we're looking at right now, but it's getting close. And that's the reason we went for a lower cap. And that's my presentation.
Thank you. Svetlana, any questions?
Yes, please. Let's open page 6 of agent brief. It's information without register should be removed from briefs.
Sure, no problem.
On page number 8, we have preliminary issue for 195 Gary Street. Municipal Board Order 1581 showed it's 2014. Estimate years, it's not relevant for 2021. Let's look on comparables, page number 10.
Okay, you're asking questions now?
No, I
And-
just state that it should be
Well, that's
removed,
argument.
it's not
Now,
relevant.
but I'm not going to disagree with you. You asked me the question and I would agree with you. Yeah, don't bother putting weight on it.
On page number 10, you have office rent comparables. Do we rely on these rent comparables?
No, these were from the first version, and so they were straightened out later on. We have a number of them, but I think that the paid rent in the building is strong enough to show its potential.
So you relied strictly on income expense mailer reported to us, correct?
No, I relied on the known rents in the building and our knowledge base of downtown Winnipeg office rents.
Okay, let's look at page number 1 of your brief. We have only 2 units occupied, rest occupied by owner. Owner occupied over 15,000 square feet. Units 4 or 3 occupied by the, if you look on page 16 of my income expense mailer, education and employment preparation service, their gross income $22 per square foot. Correct?
I believe that's what it says.
And units 404 occupied by Gosan Resource Limited. It has same $22 per square foot gross rent. Why your net rent different?
So you're referring to your evidence, correct?
I referring to existing leases at the property you rely on.
Which page are you on?
I look on your rent, net rent on page number 1 for units 403, 404.
Okay.
And I open my brief, page 16, income expense mailer for this property because you rely on the real information, site specific.
Well, no, the issue with this particular rent, that one has to be aware of is that it's a base year rent. And with Class D, you generally see this and you got a rent that's gross, and then the tenant pays the increase in cost over time. So with a base year, the rules are a little bit different on the way you calculate the rent. And they're also higher non-recoverables because not everything is impacted by the base year. Taxes are, and utilities are, but not repair and maintenance. So the repair and maintenance creeps up and erodes the base year. And that was the calculation we had done.
But it's reported same $22 per square foot gross lease for both units, 403, 404, correct?
Well, we were looking at, but oh, I know the difference. The difference is that parking is included in one, which is why we didn't put in any parking income, because all the units have a parking allocation. So you see that on our page 3, there are some notes made here as to the parking was added in for the one of them, and so that changes all the numbers. We took it as parking included.
And how we gross rent? It's net rent plus occupation cost, correct? Give us gross rent.
As I said, not with this one. It's in theory it's like that, but as a base year, it has some of the costs are added to and obtain recoveries on, and some of them aren't.
And how, what percentage occupation cost? It's correct that it's around 45-50% from gross cost, gross rent, correct? Occupation cost.
I'd have to do the math calculation here.
From your experience?
No, I mean, every building's different. I'm just looking at this. Well, this is strange. Oh, I'd have to calculate it. Oh, there it is. 244. Yeah, see, I get it to $13.70, and the person who did this was at $12.95 for expenses.
This brief was prepared by you or someone else?
They're all done by somebody else now.
So it's not your evidence?
I own the evidence. I'm presenting the evidence.
He's the applicant.
I'm the applicant. Yeah, that's it.
So, and a statement showed units 403, 404, $22 per square foot gross rent. You create a completely different number, $7, $10. How you estimate owner space, $10 per square foot? Do you have any calculation to support your evidence?
We did have other evidence, which ended up, for some reason, not going through the system that we did file. We had some rents in there. We have a database of pretty good rents for miscellaneous.
So there's no point in talking about rents that is not before us.
Yeah, so I understand, but I'm saying that formed our knowledge base. And other than that, just for sake of interest, there are in the Johnson report, and I don't know if it made the cut or not. There's a lot of asking rates in Johnson in Class D, from $9, $8 as a low to probably about $16. And we're in that range.
Colliers public record showed 6.75% capitalization rate for downtown property, and you asking 7.5%. How you can explain it? Do you
Who-
have any support evidence?
Who said 6.75?
It's Colliers report.
No, we didn't. No, we didn't. We don't track this property. This isn't on our cap rate report. If you have our report in hand, you'll also notice the definitions that are included in there. None of them say 60-year-old obsolete downtown office buildings. We don't track it.
No further questions.
Thank you. Gail, any questions?
I have no questions, thank you.
And Bob?
I have no questions, thank you.
And I have no questions. So that brings us to,
I just wanted to say very, very brief submission. I went through this rather quickly. There are pictures of the inside of the building in my report, I
yeah,
believe.
we can see them.
Okay, that's fine. Just they speak to condition. Thank you.
Next property on the docket, 298 Fort. Any preliminary issues with this?
No.
Nope.
Okay, Svetlana, you can go ahead with your presentation.
File number 22-3036, roll number 120-93114-000. We are valuing the property as a stance of January 1st, 2023, based on the economic condition April 1st, 2021. This appeal is with respect to the amount of the assessed value only. Based on the evidence in this report, in this assessor opinion, that the market value of subject property as April 1st, 2021, $1,605,000. In that, the 2023 assessed value should be confirmed. The subject property is office space located on land area of 6,052 square feet in gross floor area 7,500. On page number 2, we have subject property leases. It's medical office. Medical, we have medical, 4th Street clinic, it's showed rent $20.90. It's office, showed rent $33.90. So total reported to us area of 5,500 occupied area, give us annual rent 17,471 square feet, plus subject property has parking revenue $10,588. On page 3 and 4, further more air photo and street view of the property. It's 2-floor building. On page number 5, we have market and scope for subject property. We apply 6,510 square feet. Our total potential income $103,311. We apply vacancy loss 11%, expenses 3%, shortfall $8 per square foot. Our capitalization rate 5.2%. Subject property located 161 South Portridge. I presented 6 comparables on same neighborhood. 161 South Portridge. It's 114 Gary Street. They have area occupied area 74,248 square feet. It's 10 times more. The subject property rented $16.50. 165 Gary Street. It's rent for 2,000 square feet at $11.29. 250 York Avenue. Rent for 3,500 square feet at $16.43. Fourth comparable 387 Portridge, rent for 5,750 square feet at $26.78. Fifth comparable 226 Osborne Street, rent for $14 per square foot. 183 Kennedy for $14.52 per square foot, give us average $16.59 and media of $15.48. We assess property divide 6 by 10 at $15.87. So it's very well supported for my comparables on similar neighborhood, 161 South Portridge. I estimate 1587. We have one second. What I posted on page 9, income expense measure provided to us, where came information about existing lease. Based on evidence supported in this report, the subject property value as April 1st, 2021, $1,605,000, and that the 2023 assessed value should be confirmed. Thank you. Any questions?
Thank you. Rocky, any questions?
Yeah, I do.
You're blocking your microphone again.
Yeah, I know. I'm just falling asleep here. The workup on page, I don't know, 5, this is done by the model.
Correct.
And you're using 6,510 square feet. First, I'm looking at this income and expense form on page 9. I was led to believe that this had not been submitted in October. How is this found?
Its information was submitted due date June 13, 2021. We usually send a second letter request about information. It was submitted to us.
Okay, but when this first came to hearing, there was a penalty request that you didn't get it. Now I see that you got it. I'm just wondering how that occurred, because there's another case pending on this particular property owner, and if you've lost it.
My statement at the beginning, no penalty of this report. And we're looking submission to January 11,
yeah, well, if you
2023.
found it, in all fairness, you should be letting us know for the other property.
For what? Which property?
If you found this, I'd like to know how you found it.
It's posted on page number 9.
Okay, well, that's fine. No, Mr. Chair, sorry about that. I'm going offline here. Getting back to this, 6,510 square feet. On their statement, they indicate 5,500 square feet, and they have their tenants broken down. Why don't you use their area?
Because the gross floor area 7,500 square feet, we apply 6,510 square feet.
Did you measure it?
It's our record. It showed 86% occupancy. It's fair for this type of property.
Did you measure it?
No, our record showed.
Do you know who the owner is?
Owner Thunderchild Investment Limited.
Otherwise
It's on
known,
page number 1.
otherwise known as Barnes and Duncan Surveying. So we had a professional surveyor measure the space. Are you saying that your assessment departments might be wrecked better than the surveyor?
You didn't provide any evidence to support your statement.
Page 9, 5,500 square feet.
No answer. Our record showed 6,510 square feet.
And there are some rents listed here as well. Did you look at them and compare them to your model?
Our record showed 6,510 square feet, what we use for estimate market value of subject property. No further question, no further answer.
I just asked if you checked, you verified it. The answer then, can I take it as no?
I posted on my brief. Yes, they reported, and I verified this on page number 2, 5,500.
Your
But
rent,
our record showed 6,000 square feet. What your
Your-
questions?
your rents on page 5. Did you prepare these?
On page number 5, I prepared 6 rent comparables for same neighborhood, 161 South Portage, like subject property. And they showed range from $16.59 and in media $15.48. We applied model driven $15.87. It's fair. It's very well supported by my evidence.
I know, but did you collect these rents for this report?
Yeah,
Okay.
it's my rents.
And what class would the subject be?
Office building located in South Portage. All my 6 comparables, office space located in South Portage.
What would be the market classification for it? Do you know if it has one?
I don't know.
Okay.
In my records, it's office space.
And on your comparables, do you know what the classifications are on the ones that you've provided here?
It's office space.
Well, there's quality of office space. Do you think all office is the same?
That's why I showed range
Okay.
for similar properties.
387 Broadway, for example, is Class B, correct?
It's not relevant. It's office space.
It's your opinion it's not relative then.
Yes.
Well, then why is it a rent if it's not relative?
And it showed rent for around 6,000 square feet, $26.78. And we apply less than $16. I showed range how model pick number. I support model data.
But are you supporting the model data with?
Model numbers.
Are you supporting model rent
Driven numbers,
with
rent.
superior properties?
It's same office space property in our portfolio.
And
In same neighborhood.
you have a
And
building.
model look for this property.
You have a building that was built in 1912. How did it become 1975?
All building in downtown, most of the building in downtown, 161 South Portage, old building built beginning 1900.
Yeah, well, what made it change the date of it?
Could you repeat questions?
Well, how did the effective year get changed from 1912 to 1975?
Because office building, when you have capital renovation, lifespan increase, effective years built increase. On market, office space can be available 16, 17 years. If you don't put any renovation in existing building, it will be demolished by today.
What renovation was put into it?
I don't have information about it.
Did they change the foundation?
I don't know.
Okay.
I didn't have time to investigate this.
If this building were classed as 1912, would the cap rate be different?
Cap rate 5.2% generated by model. It's inside average rent between 6 and 6.75. It's 60% of the property inside is capitalization rate.
Would it, at 1912 age, would the cap rate be higher?
No, I don't know.
Okay. And on your page 7, this 5.2% is below your 20th percentile, correct?
Correct, because it's 60% properties.
Pardon me, what is a 60% property?
It's from 20 to 18 percentile, 60% property for office from 5.6 to 6.9, all office range.
Yeah, but this is below your 20th percentile. I mean, it's built in 1912. Do you think maybe the model could have made an error here?
This building less than 7,000 square feet. It's small properties. It's more people can afford to buy this property. More purchased market. More people can afford that. Why it's drive capitalization rate much lower. Why model pick up this number? It's and model analyze all existing sale prior to reference date.
Have you got an authority that defends having a lower rate for a smaller building?
I defend model driven 5.2%. Yes, it's
No, but,
outside
like
our 16th percentile.
a textbook, a theory that's written on there. Where does that come from?
It's my statement.
But you haven't brought evidence to that effect, have you?
It showed if you see City of Winnipeg, 16% of property between 5.6 and 6.75%. But for this specific property, model generate 5.2% because it's small property and selling sale for more people can afford this type of property. That's why capitalization rate going lower for small type of property, small square footage property. It's what our model analyze for all existing sale across the city.
On your page 7, you've indicated 3 companies who provided market reports. Your cap rate is lower than any of the lows they have. If you're not going to be able to, why would these people be included in your cap rate study when they can't support your cap?
No answer.
Well, do you think it's rather strange that 3 companies who sell properties would never cap anything this low?
I already stated that small property
let's move
driven
on beyond the cap
capitalization
rate.
rate low because it's more people can afford to buy it.
Let's
That's why
move on beyond the
capitalization
cap
rate less than 16th percentile.
Let's move on beyond the cap rate, please.
Have you ever inspected this property?
No.
And what would be the restrictions that it would face from heritage and conservation? Are you aware?
I don't know.
Those are my questions.
Thank you. Gail, any questions?
No questions, thanks.
And Bob?
No questions, thank you.
And I have no questions. So Rocky, you can make your presentation and just get it up here.
Yeah, okay, so I've got the 13-page one. So the property is owned by the people from Barnes and Duncan, and we did have a mailer, which again, I'm puzzled. Request the penalty, here's the mailer. They have another property, it's concerning me, but that's not for this hearing. They did report 5,500 square feet, and it was measured by a surveyor, a professional, not me, that's for sure. The calculation of the net rents. Now, there's a couple on the tenant roll, page 3. The medical corporation has been in there a long time, dating back to at least 2003, and those are a series of renewals. That works out to $20.90 gross, my calculation, and it looks like costs to carry are two ways of calculating it. One would be on the former assessment, one would be on the new assessment, but they're at least between 10 and 14 a square foot. So the net rental rates that it's generating are between $6 and $10 for that medical user on the main floor. The second floor is a short-term rental, and you can see by looking at it, it's a 2-year term, and it was looks to me like there's a typo there. I thought it was Boxstall, who were using it as a construction office on a nearby project on a short-term lease. And that does come up at approximately $30 gross. So the net on that for the short-termer is about 16. Now that's a short-term lease, so you're going to see a much higher rent for it on that. Oh, Baccato. No, I don't know how that's pronounced. Our calculation of the income was estimated at $11.27 on the main, which it is renting for, and a $10 rent on the upper level, which they always rent for less. It's a walk-up. It's not no elevators for sure on 5,500 square feet. The calculation on vacancy is just an indication of the problems they've had. They've had a 50% vacancy since Barnes and Duncan departed, and that happened in 2018. So it has been 3 years of vacancy, which is chronic. What we do with this vacancy in this case, it's a little bit easier than the other properties as we look at kind of stabilizing it out. So actual vacancy is 50%, downtown office is 9.9, Class D is 4.8. It's good, which this bill is kind of flying in the face of that. So that's why we're using 21.57%. And non-recoverables at 5%, and structural at 2% for a total of 7%. Shortfall calculation is based on tax rate, which is as is, and that's $7 a foot with utilities and maintenance. About $10.45 on the shortfall. It's just the cost to carry when it's empty, and we've capped it at 8.25. Now, I think that some of the issues with it are really obvious. The fact of its age, by the way, I inspected this property right after some work was done in 2003, and what they did at the time was they put a new cladding on the front and the side. So they had that steel cladding on the side and some brick veneer on the front, and then on the inside drywalled over some of the brick and rejigged the cooling system, heating and cooling system. There was no and new windows. There was no major changes in there. They did not make it younger. A 1912 building built on a rubble foundation with timber framing, it does not get younger, period. That's a misuse of effective year built in this case. Quality and condition are weak in the market because no one's looking for old space like this. The vacancies have proven to be a difficult thing to deal with. There's no real demand for any $10 rents in the area. It's probably going to have to drop to its level, to its as they say, it's the level of water. It finds its own amount. It's been attempted to be marketed for the last 4 or 5 years now, and this is all that they're getting. So I think that 8.25 is being overly low. My thinking on it was, and I didn't prepare this, but I know that when you go to try to demolish a building built in 1912, you do not get a demolition permit just for asking. You go through conservation, which will be a delay of a couple of years, and then they'll determine if it's to be protected or not. So the risk on that is that if you did have some sort of upside on the land, 6,000 square feet, that you're not going to be able to achieve it. So you are stuck with what you have. The owner actually decided to move on because of lack of parking, because of their surveying trucks didn't have enough room in the back, and so since then it's been a difficult situation. When I looked at the value here, and then I look at the assessment from last year, and I'm not stunned. I don't think that that's an issue. The 2020 assessment is under appeal. They paid nowhere near that for it. They invested nowhere near for it, and they're certainly not earning any money on it. That even now, with their potential income on it, they're earning perhaps $50,000 a year before expenses. So it's not. There's a mistake here somewhere. That's my presentation, and there is some rebuttal.
Thank you. Svetlana, any questions?
Yes, please. We have 13 pages of brief. Let's look into page number 4. It's a case management report without prejudice should be removed from the brief.
Okay, you said it on the previous one. It will carry
Yeah.
forward to all the properties.
We have same preliminary issue of 2014 on page number 6. Page number 8, we have office rent comparables that not support rent of subject property, correct?
You can stay and look at them. I don't think there's an issue. If you're going to use 1780 Wellington Class A to compare to miscellaneous D, why would you complain about me?
So you rely only income reported, specific, site specific, all your estimation, correct?
No, I just said don't remove them. You can look at them.
But you don't rely
Well,
on
actually, no. There are some rents in here to look at, page 8.
Let's look.
And I missed this earlier to answer to the previous building. Bottom of the page, 250 McDermott, $6. 115 Bannatyne, $7. 54 Arthur, $5.44. Those are all loft buildings in the exchange area that are the same vintage as the subject. So we have 3 rents there. Up further, there is more from 54 Arthur plus 123 Bannatyne. They range from $5.50 a foot to $8 a foot. And that I would rely on those ones I just quoted you.
And this rent on Bannatyne Arthur start in 2016, correct? And they put upward adjustment for 5 years?
No, there's no upward adjustment there. It doesn't depreciate in value in a building of that vintage. The goal, as I said earlier, is to keep it full.
And rent on Bannatyne, it's over more than 4,000 square feet. Should upward adjustment for low space, correct?
No, I don't see that.
Let's look on your page number 1. You have a main floor occupied and second floor vacant. You apply $10. So yeah, your gross potential income 58,000 only, correct?
That's correct.
And subject property reported over 17,000, rent just for half space occupied, correct?
What are you referring to?
Income expense mail provided to us. They showed that
what page is that?
I don't know, 1 second. Because you income expense mailer, you posted on page number 3.
It's the same mailer that you put in your brief.
Correct.
So
And
then
you
my
can see
question
on
is-
page number 3, we have a lease existing, and they show just for this occupied space, $17,471. And
Where,
it
where,
just
where is
occupied
this?
space. If you use rent on page number 3, leasable area, monthly
Oh,
rent, you came across 17,000 just
mean-
for
you mean-
occupied space.
You mean 70,000,
70, yeah,
69,000. Okay.
471. So it just for occupied space. And you, in your estimation, you apply $10 of vacant space, and still your gross income 58,000, correct? Less than 17,000.
Absolutely incorrect. You have not read the form correctly. That's a gross rent. Go look at line item number 218, which is $26,555. This is a gross lease.
Do you account for parking revenue over 10,000 square feet?
We've
Over
included,
$10,000?
we've included it
Where?
in the rent for the space. It's not rented out to people. It's not available to the market. It goes with the space.
And usually, if you state that it's gross rent, usually net 13% less, it will be $10 or $17, correct?
No, I don't know what you mean.
So my statement is gross potential income, you estimate occupied space and vacant space, less als 39,000, and they reported just half building occupied, 7,000, it's not supported by income expense mailer, correct?
No, I don't know what you're saying, but it doesn't sound right.
Okay, no further questions.
Thank you, and yeah,
I have no questions, thank you.
and Bob,
I have no further questions. Thank you.
and I have no questions, so that concludes that part.
Oh, no, I got rebuttal.
Oh,
It's in the folder, Mr. Chair. I send you another email, Ms. Shebel.
It's a rebuttal on my evidence, or it's brand new evidence again?
I don't know, I don't have it.
It's labeled as 223036 applicant rebuttal.
Oh, now I see it.
Got it.
Yep,
It's just photo, correct?
yes.
Okay.
This is new evidence.
It's new evidence, that's it. Nothing to talk.
Absolutely not. It's all in response to questions asked of the assessor.
Well, we'll take a 5-minute recess. I hate to do it, but we will.
It'll take me less than 5 minutes to go through it.
No, we're going to do this properly.
Okay, then if that's the case, then I should be allowed to make some argument here. None of this is new evidence. I asked the assessor, how did it get from 1912 to 1974? That was written evidence. They changed it. I have pictures of what it looks like that was taken after the so-called renovation. I'm proving that there's no change in the date. Then on page 3 is a description which I wrote in 2003 when I went and inspected it. Now the evidence on page, the 4th page is, we've already heard it, so it doesn't matter. The 5th page is to show you it was Barnes and Duncan. You've already heard it. And page 6 the assessor said that it was because of permits. So I have copies of the permits for your review.
Page 4 is a mailer from 2015.
Yeah, I'm just saying we've already been through it, so we don't have to look at it again. It's
We
just
haven't been through this particular mailer.
no, but it's just to show 5,500 square feet. That's already been in the evidence already, and you don't have to worry about that. I'm not planning on addressing it.
It's still new evidence, I object.
Okay, we're going to take a 3-minute recess.
Okay, yes, Mr. Chair. Be alive, Mr. Chair.
Thank you very much. We'll reconvene the hearing. And we've considered the brief from the applicant, or the rebuttal brief from the applicant. And we will exclude the mailer. And we will place the appropriate weight on the pictures if you want to speak to them verbally, Rocky.
Yeah, sure. Okay. No, I mean, this isn't a big thing. First picture is a basement. And you can see that there's the post, and it's they took drywall and covered up an old timber strut with the when I forgot the name of the top part there that goes into it. That's all they did. A drywall coat. You can see part of the rubble foundation in the back, and it's a mix of rubble and brick. Second picture is also the basement, and you can see along the wall that there's nothing been changed. It's just a layer of covering. The most interesting one is the second page, the top. They couldn't redo the venting system because there wasn't one installed, so they did surface mount tube. Rather ingenious, but not very nice looking way of distributing their HVAC. Adds really nothing to the life of the building with a system like this. Next picture is the inside of it, just drywall added. Picture of the back, the bare brick and the fire escape added. Bottom of that page 3, something I wrote in 2003. So I've been in there and wrote this inspection, just give you an idea of what was changed and what didn't change. It mentioned that the doors and the windows were redone. We still haven't got across anything that's of any import. The measurement done by the owner, Barnes and Duncan. On the 6th page, these are the permits that have been taken out there in the city records. They appear to go back to 2002. And, you know, most of these are just so small, like a little bit of wiring, repair, a face for a sign, plumbing alteration. And the bottom one from 2002, interior alterations for a new tenant occupying the 2nd floor. That's your drywall. I don't think this is rebuttal. This is probably primary evidence. I just listed the attempts to market it. So we, you know, put whatever weight you want on that.
Okay, thank you very much. Svetlana, any questions?
No questions.
And Gail
No questions, thank you.
and Bob.
No questions, thank you.
Thank you. That brings us to the next property, property number 5 on the docket, 180 King Street.
Yeah, I'm really not sure I can keep going, and I'm not saying that for any. I would rather the mics be turned off, but I don't think I can do this.
So, oh, sorry, well, I hate to say it, we'll take another recess. 5 minutes, sorry.
All right.
So
We are live, Mr. Chair.
Thank you very much. We'll reconvene the hearing. And at the request of the applicant, we will adjourn this meeting to a later date or continue on this meeting to a later date.
Thank you, I appreciate that. I think we have a fair amount of openings.
Well, you may.
Oh,
Well, I can't do the date today.
yeah. There's a couple of spots, so I don't know what they can work out. I wish we could, but
That's up to the administration.
yeah.
Okay.
That's it, Mr. Chair. Can we just cut it off?
Yes.